Of the day, forget about it. Gregory Vallier, AGF Investments, that is the interview of the day as Mr. McConnell herds cats. We'll do that next. This is Bloomberg Futures up 15.
Said that the idea that China is our competition is really bizarre. Well, watch what happened. Not a good situation. Their freedom's been taken away, their rights have been taken away, and with it goes Hong Kong, in my opinion, because it will no longer be able to compete with free markets. A lot of people will be leaving Hong Kong, I suspect. And we're going to do a lot more business because of it, because we just lost one competitor. You'll see more coming. This was a very important bill that we signed, but you're going to see more coming over the next short period of time. But we can impose massive tariffs on China if we want, and other countries if we want. And we'll see. We just want to be treated fairly. Tremendous amounts of our energy No administration has been tougher on China than this administration. We imposed historic tariffs. We stood up to China's intellectual property theft at a level that nobody's ever come close. We confronted untrustworthy Chinese technology and telecom providers.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Good morning, everyone. Bloomberg Surveillance from London, from New York. Let's get right to it. Our interview of the day, without question, with Gregory Vallier with AGF. Moments ago, he published his morning note, and I want to give you a quote from it, folks, which explains, particularly for those of you around the world, the moment the United States of America is in. This congressional gamesmanship seemingly ignores the unfolding impact on people's lives as evictions and bankruptcies surge. Greg Vallier, what is the Republican leadership thinking?
That's a great question, Tom. Good morning. I think that they're facing a public relations debacle with people wondering why it's taken them this long. Now, we'll get a positive story. McConnell will have a bill out late today. But then the hard part begins. There's a lengthy negotiation between the Democrats and Republicans that could last at least a couple of weeks.
The New York Times on Friday, Bella Coetze, I believe I'm pronouncing that right, their wonderful graphics artist, did a spectacular dynamic study of $600 a week. Greg, it's irrefutable that some poor people are motivated to stay at home, but the Republican approach crushes a huge body of the lower working class of all political persuasions. What are they thinking?
I wish I had an answer. I think they do face quite a pushback. You know, Nancy Pelosi is not going to agree to a piecemeal deal that just deals with unemployment benefits and doesn't touch state and local government assistance. There's a lot of stuff that has to be in a bill, and I would say not to be too much hype here. You know, we did the wrong thing in the early 1930s. The government in Washington went for fiscal restraint. Are we going to do the same thing now and not do anything? If this drags on into September, the impact not on Republicans, but the impact on the economy is going to be very negative.
Greg, what do you think we'll end up with? So, you know, is the total amount just as important on where the funding goes?
Yeah, I think we'll wind up with a bill at about $1.5 trillion. The McConnell bill was late this afternoon will be $1 trillion. I think we'll surely go up to 1.5. There will be money for state and local governments. So a lot of aid for schools, for paycheck for everybody under a certain level of income, a lot of money for testing. It will be a pretty big bill in the final analysis. The problem is it's going to take a while to get it.
I mean, but the money is needed now, right? Or it was needed yesterday. How long can this go on without people really starting to suffer?
Well, we're getting to that point. We see the data coming out. Unemployment claims last Friday went up. I think the economy is now starting to soften. You look at the Southwest, the Sun Belt, the new COVID-19 cases. I think the economy needs aid immediately.
Greg, I want to go to the politics that you're going to see today. I guess we're going to get a bill today as well. Where is McConnell's majority to lowball this? Is it like a resurgent Tea Party? Does Mark Meadows have a quiet group of people we don't observe that are pushing this forward against a moderate common sense?
There's a lot of Republicans who worry with justification that the staggering deficits that we're running up, and they don't want to spend any more money. I would argue, Tom, in the final analysis, the key player is Donald Trump. And Trump needs a big stimulus bill. He needs a better economy if he wants to win re-election. So I think he'll be the one who will push for a bigger bill.
What does he do? What's the actual mechanism this president does with the ratings and the polling and all that to motivate the Southern Democrats to not lowball this stimulus? How does he affect that?
He goes to Mnuchin, he goes to Meadows, he goes to McConnell, and he says, if you don't pass a robust bill, I'm going after you. And Trump's track record of going after Republicans who don't support him is a pretty good track record. So I think Trump himself will be the catalyst here in getting the bill up to about $1.5 trillion.
Greg, will people remember this come November in the election?
Well, that's a good point. They'll remember the last set of economic data they saw in October, and right now it's looking like the economic data for this third quarter is not going to be that V-shaped recovery that the president had been hoping for.
Why is the president doing so badly in the polls right now? Is it 100% the COVID handling?
Mostly, there's a new poll out this morning showing his number in COVID handling is now in the upper 20s. I mean, when you get a number like that, you're in real trouble. And the polls quite clearly have shown in states like Michigan and Pennsylvania, Trump is trailing badly.
Greg Valliere, over the weekend, the Reagan organization, the museum, whatever, went after the president and said, stop linking yourself to arguably the modern Republican imagery of Ronald Reagan. Were you surprised by that?
Not really. I thought for a while that Ronald Reagan could never win the nomination in that party. I'm not even sure George W., or certainly his father, could win the nomination in the party. The party has veered way away from what Ronald Reagan was all about.
Greg, thank you so much. Greg Valliere, their AGF Investment Chief U.S. Policy Strategist. Now, this is what the markets are doing. The markets are looking at U.S., China, and are looking at worrying signs, which is why we're still seeing gold piercing above the record, and actually it could touch 2,000. The other story they're watching out for is, of course, number of infections Spain battling, for example, Tom and I were talking about it earlier, to try and actually rescue its tourism after the UK ordered a quarantine really at the last minute, Tom.
About $43, 1968 an ounce. That is a wow statistic. We got much more coming up, but the real story this morning is, as Greg Valliere mentioned there, a more tepid GDP. Coming up later, Catherine Mann will be with us with Citigroup in the 10 a.m. hour. We'll get a recalibration of the Citigroup view on the American economy. It is decidedly a moving target right now. The 10-year yield, 0.5708 on the 10-year yield. Dollar weaker, now down to new weakness on DXY. The euro, wow, 117.22. Stronger euro against a weak dollar. This is Bloomberg. Good morning.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Tom, Nasdaq futures starting the week on a positive note. Days ahead, though, could be rocky given the events that could increase tech sector volatility, much like the swings that we saw last week for companies such as Intel and Tesla. Now, to talk about the tech sector, let's get straight to Stephen DeSanctis. He's Jefferies equity strategist. Stephen, great to have you on a day like today. What worries you the most? What part of the tech looks frothy in terms of valuations?
Well, good morning. I think obviously we've penned a piece on the Sweet 16, so it was more than just tech and and the FANG stocks. We broadened it out to include a handful of other names. And obviously, these stocks have been the place to be. They're up 20% year to date, the NASDAQ 100 and the QQQ. I think there's other areas of the market that are starting to look a lot more attractive. Hopefully that we get a better economic balance, and that gives you the rotation back towards the cyclicals.
Right, but what do you do with something like Amazon right now?
We have at Jefferies, we have a price target of 3,800. So I don't cover individual stocks, but that is our target for the firm. And I think the way you think about it is that, I mean, these are great companies, but what you want to think about is there's potential pause in terms of performance. We've seen a little underperformance, and I think that's a good thing. Some of the froth has to come out of the market. Obviously, tech has been the place to be, along with healthcare. And I think there's you take a little bit of money out of some of the growthier, frothier areas and start to look more towards the cyclicals that have not performed nearly as well.
Steve, on the income statement, where is a partial differential driving these stocks? To me, it's revenue, revenue, revenue. The revenue numbers. Your colleague in crime, Joe Feldman, over at Telsey today, republished to get almost to your target. He's at 3,600. You guys are at 3,800. And to me, it's just a double-digit revenue exercise. Or am I missing it?
Nope, you're not missing it. I mean, that's the key driver, revenue growth. And it's the fact that there hasn't been revenue growth outside of these handful of stocks. And in a low-growth environment, that's what you end up seeing, right, is that people are going to pay up for revenue growth. The thought process is the economies get better in 2021. Global growth starts to reaccelerate. You start to see revenue growth broaden out and earnings growth start to broaden out. And then you start to see a little bit of that rotation that everybody's been talking about. I think the one other area, Tom, is the fact that, people perceive these companies as being, bulletproof from a balance sheet standpoint. They are. They've got cash flows. They've got very clean, good earnings, good visibility. The debt levels are about average right now relative to the overall market. But you're right. It's all about revenue growth.
Well, we triangulate here, folks. What we do is we go, okay, it's stupid to buy ABC stock right now. Steve says buy ABC stock, but I'm going to triangulate out 1 year, or I'm going to triangulate out 2 years. How many years am I out, Steve, right now? Am I pricing out 4 and 5 years to rationalize the marginal purchase this morning of your Sweet 16?
I think that's the way you look at it, is the fact that, if you look at their 3 to 5 year earnings growth forecast for the list, the median is still talking about, north of 20% earnings growth for these stocks. So people say, gee, in the near term, I may be able to find better growth somewhere else, but over the longer term. But again, these stocks are trading at 7 times revenue, roughly 7 times revenue. So you've paid for an awful lot of that growth, in my opinion. And the difference between the cheapest stocks and the most expensive is the widest that we've seen since the tech bubble. Can you have a rotation back towards those names that are a little cheaper? Yes, I think that's possible, given, if the economy does get better and revenue growth and earnings growth starts to broaden out, maybe you don't pay 7 times for the Sweet 16 list.
But Stephen, why are people, paying that multiple? I keep on hearing that, what we're going through the pandemic is just accelerating the techs that we've seen in trends. So it's not actually changing a trend. It's just bringing it forward by 3 to 4 years. Is that correct?
Yeah, I think that really is. That, again, there's nothing else out there. These stocks are growing. They're continuing to take market share from the unfortunate. And so that has driven up the valuations. But I think you get to a point where you've reached kind of maximum capacity on buying some of these names. Like, who's going to be the last person? Who's going to continue to keep buying or putting money into, the same names? Now, obviously, ETF flows drive that. Money comes into the ETF. These stocks are very big parts of the ETF, so they have a lot of that momentum behind it. But our thought process is just simple: 5% of, if you have a 5% dip in these stocks in terms of their interest level, that's about $500 billion to go elsewhere. And so you start to think about that and say, gee, these stocks are really expensive. I can find earnings growth elsewhere. Maybe there's something to the economic recovery. And so you start to see a little bit of that rotation and giving it a tailwind to some other stocks or some other groups at least.
Thank you so much, Stephen DeSanctis, there, Jefferies equity strategist. Now, up next, we speak with Dr. Joshua Sharfstein, Johns Hopkins University Vice Dean for Public Health Practice and Community Engagement at the Bloomberg School of Public Health. This is Bloomberg.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keeney in New York. Futures up 19 now. That's a high for the session. Dow futures up 127. The VIX 26.17. Front and center is a lower yield environment this morning. Gold 19.66 an ounce, up a big $41. Right now in the pandemic, right now in the virus, someone who's been with us often with the Johns Hopkins University and Vice Dean for Public Health Practice and Community, Joshua Sharfstein, joins us. Joshua, I'm looking at the calendar. And you know, in the Midwest, in the South, high school football starts literally in 10 days. The seniors come back for sports, and they start early school. Would you let schools open right now with what you know about the virus?
I'd be pretty reluctant to do that in areas where there's a high amount of spread, and I'd be especially reluctant to doing high school football, which really requires a tremendous amount of contact, obviously, and has been shown with all these colleges to be a place where virus gets transmitted.
I mean, it's an extraordinary moment for the country. It's July 27. In 10 days, it's going to be more urgent for the East Coast as well. How do the masks work in a school when the kids are trotting around the hallways?
Well, I think part of the idea for schools is to reduce the amount of trotting around in the hallways. For younger kids, you keep the kids in a class. For older kids, you might move the teachers in between classes, but really, it really shouldn't look anything like it did last year in terms of crowded hallways.
Joshua, but this could be, and this is, of course, you know, what governments have to choose around the world is public health, you know, compared to the people that, you know, can't have an education at home, and the benefits that actually being in a classroom from students are. Who's the best person to choose these kind of, you know, difficult lines between the economy and public health, between, you know, saving lives, but also not letting people starve or go uneducated?
Well, you know, what we did was we sort of consciously picked the economy, and it's collapsed. You know, that the whole approach has not worked. It's really important to follow the path that so many other countries have done, where you really take care of the virus, you spend money to keep people fed and housed, you don't let evictions happen, and you beat back the virus first, and then that allows you to have more of an economy. People who are jumping to, like, let's have the economy are now finding out that the consequence is an enormous amount of viral transmission. So I think it was a bit of a false choice back then, as it is now. And, you know, one other thing to note, individually, people are pretty risk averse, right? People are afraid to do things because they're worried about the virus. But socially, we've been kind of reckless in a lot of places. We've been, you know, opening bars, you know, encouraging people not to wear masks, telling people this is all behind them, it'll go away. And so we need to line up our social policies with the individual risk aversion that we feel. If we want to protect schools, if we want to protect nursing homes, other places, we have to do that together, not just one at a time.
Does the message to people have to be that we could have to do this for the next 2 years? Were people quickly to dismiss that actually, you know, we've gotten over the worst and then the virus was under control?
You know, back in the spring, the path was pretty clear. Really be vigilant, drive down the cases, slowly open up with public health capacity to do contact tracing. And containment, and focusing on the highest risk areas and some of the underlying issues causing infection. We didn't do that then, but we can have a do-over. The do-over doesn't mean you shut down for 9 months. The do-over means you shut down long enough to really drive the cases down, and then you're vigilant, you slowly open, and you have the public health capacity.
Joshua, you came out of the Boston Children's Hospital Combine in Harvard. You wandered down to Washington with Henry Waxman, and you did a lot of work overseeing the FDA. You've got a real political savvy from the medical side. What do you want from the politicians right now?
I think much more of a sense of responsibility from the top. I mean, I think that the characteristic of the White House and the administration has been, this is not our problem, this is the problem of the states. And we heard that over the weekend. It's enormously frustrating. I think one of the most important roles for leadership is to take responsibility and to help illuminate a path. You don't have to dictate every decision, but illuminate a path forward instead of just saying, you know, this is really your problem and good luck with that. And I think that is going to be seen as one of the major failures of leadership right now.
Joshua, thank you so much. Joshua Sharfstein there of Johns Hopkins. And be sure to check out VRUS Go on the Bloomberg for the latest information, and tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, turning to the airlines, Europe's biggest discount carrier, Ryanair, posted a loss of 185 million euros in the 3 months through June. The chief financial officer, Neil Sarazan, told Bloomberg's Nerd Chase that he does not expect the company to start turning a profit until 2021.
We're planning this year to carry about 60 million customers in our business, which is about a 60% reduction on what we carried last year, where we had 149 million. And as you rightly said, you know, we had a very difficult quarter where we made a loss of 185 million. We would be hopeful that the losses into Q2 are somewhat lower than we saw in Q1.
Yeah, so just talk me through as to what impact that could actually have on the numbers. I know it's difficult to predict, but if those second wave fears materialize to the extent that we start to see more quarantines imposed to other countries other than Spain, does that mean potentially several quarters of losses, Neil?
Well, I think this year you're not going to, and we're not guiding for the full year, but you're not going to see profits in the current financial year. I think you're going to have to look into next year before you start to see a recovery on that front, and that's why the likes of cash preservation is hugely important. We ended the quarter with 3.9 billion cash, up from 3.8 billion in the previous quarter, which puts us in a pretty strong position as we go into the winter period. Equally, we've got a lot of competitors who are receiving significant amounts of state aid, which I think is inevitably going to lead to some form of below-cost selling from them, which will lead to reduced fares. So it's very important that the likes of Ryanair right-size our business, and we're doing that. We're getting our cost base into even better shape than it was. We're reducing our labour costs. We're reducing our airport and handling. We're working with our aircraft manufacturers and lessors to reduce the cost of aircraft and lease rentals going forward. So we're planning for these kind of scenarios within the business. We would hope, however, that the trace and track strategies put in place by governments will help stave off a second wave and huge lockdowns. We would also be hopeful that we'll see some kind of a vaccine either this year or early into next year, which will give people a lot of confidence in flying.
That was the Ryanair Chief Financial Officer, Neil Sorohan. Now, up next, we speak with Liam Fox, the former UK Trade Secretary. We'll talk about the World Trade Organization. This is Bloomberg.
Opportunity knocks at the door. Don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the campaign to lead the World Trade Organization has officially begun against the backdrop of a pandemic, a worldwide recession, the U.S.-China trade battle for trade supremacy, and the American presidential election. Well, there couldn't be more at stake. Liam Fox, Britain's former Secretary of State for International Trade, is in the running, and we're delighted to be joined by him today. Liam Fox, thank you for giving us a little bit of your busy day. If you look at how critical you were with China's handling of the pandemic at the World Health Organization, what's your view on China's role at the World Trade Organization?
Well, what's clear about the whole of the trading environment, as you mentioned, is that it's faced with a new crisis with COVID, but it actually was in crisis. I would argue before COVID, global trade actually contracted in the final quarter of 2019 for a number of factors. The US-China trade tensions was certainly one of those, but we also had seen amongst the G20 countries in general an increasing protectionist trend since the end of the financial crisis. Back in 2009, only 0.7% of the G20's imports were covered by restrictive measures. By the end of 2019, that was 10.3%. Now, so you've got a number of things happening simultaneously. You've got that increased protectionist burden. You've got the US-China trade tensions, and you also have a cyclical element coming from 10 years of growth in the global economy.
Okay, as Director General, how would you resolve the US-China trade tensions?
Well, in a sense, they have to be resolved bilaterally. I think that what's our experience over time, it's that these things tend to be resolved because of the financial cost that they apply to those the parties to those disputes, and it will undoubtedly have a drag on GDP in both China and the US, the fact that they're facing something like 28% average tariffs. The question is, in an economic downturn that we're likely to see post-COVID, is that a burden that the respective governments are willing to carry through? As for the WTO needs to make sure that the rules are being fairly applied. I was in 2018, as you say, as UK Trade Secretary. I did 5 visits to Beijing, 5 visits to Washington, and all the time our argument was that we're on the side of the rules-based system, because the alternative to a rules-based system is a free-for-all, and that would be catastrophic for a number of countries and very difficult for a number of others, including countries in Europe.
Donald Trump says the WTO is the worst trade deal the U.S. has ever signed. Is he wrong? Why is he wrong?
Well, it's not a trade deal. It's a system by which we introduce standardized rules so that we can operate in a more predictable fashion. It's also worth pointing out that the U.S. has won something like 92% of the cases that it has taken to the WTO to prevent unfair competition elsewhere. So I think those numbers are very important to look at. I think it's fair to say that the WTO hasn't brought itself up to date as much as it should have. So we're still lagging behind in areas like e-commerce and on tech trade. But we're still stuck in discussions around agriculture and fisheries, which really do need to be resolved quickly. The point is that all those discussions and all the blockages are political. And my argument is that they are best resolved by a DG who's an elected politician with global experience. Because frankly, in those difficult discussions that you allude to ahead, I think that it's much more likely that a politician with experience rather than a bureaucrat would be able to achieve that.
The Airbus-Boeing dispute has taken 15 years to resolve. How, as DG, would you help make it easier and faster for nations to actually resolve some of these disputes?
It's a key issue, and we have to start by getting the appellate body up and running. We have some ideas how we might do that, which we'll be putting forward as we go through this process during the DG selection. But clearly, it's a nonsense. If you can behave in a way that's against the rules, but it takes years for your competitors to be able to get redress, that is a license for people to behave outside that rules-based system. So we need to bring those timescales way in from where they are at the present time. That will require all the countries involved to agree to new processes. Again, I think that's best brokered by somebody who's used to that milieu.
Liam Fox, the U.S. Trade Representative, Mr. Lighthizer, says you two are very close. Are you concerned that your closeness to the Trump administration could upset China and the EU, who both have veto rights?
Well, I think anyone who's dealt with me in any of these countries will know that I have a reputation of being even-handed, and that Britain has a reputation for being not just a safe pair of hands, but very pragmatic. The DG is not their own country's DG, nor any candidate country's DG. They have to be independent. And that was very nice of Bob Lighthizer to say that we were one of the front runners. But I always thought there was a big difference in a horse race between being able to identify the front runners and actually putting your money on them. So that's a decision that has to be made in Washington.
What do you think could be reasonably achieved at the ministerial meeting of WTO next year?
Well, I think it needs to recommit to the principles of the system. And I think that we need to get back some of that vision that we had way back in the 90s that enabled us to do such tremendous things. But we will also have to have a practical reset. The issues that you mentioned on things like dispute resolution need to be dealt with, but we'll also need to take stock of where we are post-COVID and how we get the global economy opening up, because I believe that our best resilience is achieved through diversity of supply and keeping that global economy open in things like food and medicines, remembering that about 17% of all those in our planet today are dependent on an open agricultural system to be able to feed themselves and have food security. So there are a lot of cross-referenced issues between economics and global security, and the ministerial conference next year will have to take cognizance of all of those.
All right, thank you so much for joining us. Liam Fox there, the former UK Secretary of State for International Trade, joining us this morning. Now, coming up, join Tom Keene, Jonathan Fair, and Elisa Abramovitz for more Bloomberg Surveillance, simulcast on Bloomberg Radio and TV from 7 a.m. in New York, 12 p.m. in London. So that starts in a couple of minutes. I know a lot of the focus from the other Bloomberg Surveillance crew will, of course, be on gold. They'll also talk about treasuries and Amazon. A big focus today on technology stocks. This is Bloomberg.
The Nissan Ariya is the one that represents for the Nissan new chapter. I would say that the Nissan has a great experience because we have 10 years of the history through the Nissan Leaf. We have learned a lot of the voice from the customer.
markets don't like uncertainty, these binary risks which are impossible to hedge, with an equity market near its highs, I think buying some treasuries for safe haven makes sense here.
It's very difficult to imagine when and how the Fed's going to start hiking. Now, never say never, but we're looking many, many years into the future.
I don't think we're going backwards. I just think we're slowing down and we're going to level off in terms of the recovery.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance with equity futures positive. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Farrow. Tom Keene, the price action this morning, we come flying out of the gate ahead of the trading week. With equities positive, the dollar weaker, treasury yields lower, and gold breaking out. Can you make sense of it?
Well, there's some real breaches of support here. Let's start with the dollar, where there's a clear breach of support. Euro-yen is what you first look at, John. Euro-yen takes out the dollar and shows you the dynamic away from the dollar. Translated, it's all about the dollar, and it's a weaker dollar across the board. What I would look at, John, is yields, and I'd really look at the inflation-adjusted yield. The 10-year TIPS is a negative 0.92. That breaches the 2012 nadir. This is a market screaming economic slowdown.
Two numbers for you, Tom. 2 trillion and 99 days. 2 trillion spread between the Republicans and Democrats and 99 days until the election.
Yeah.
Tom, you have to believe that ahead of the week ahead, the president has to step forward and say it needs to be bigger. We've got to go big.
Greg Valliere, an hour ago, no question about it, John. He said that that's where we're coming to, where the president just reads the riot act to his Republicans about losing the House, losing the Senate, losing the presidency, and getting out. I'll be honest, I don't think it's 1.5 where we're heading with Mr. Trump is 1.6, 1.7, whatever that number is going to be. But, John, what I would focus on in a week of technology earnings is how equities are so resilient here compared to what else you and I see on the Bloomberg terminal.
Massive week ahead, Tom Keene, including the Federal Reserve decision this coming Wednesday. Let's get to the morning brief the week ahead. A Fed decision coming up later this week. Tech earnings in the mix. Some tech hearings as well. Then we get US GDP data later on in the week as well.
Yeah.
Here's the price action to kick things off this Monday morning. Equity futures up 15. We're positive 0.5%. In the bond market, yields head south by 2 basis points to 0.57. And Tom Keene, I've got to say, euro dollar got bought at 116 pretty quickly. 117.23. The dollar breaking down, the euro breaking out.
Yeah, I don't know where that XAU quote is. That's a European quote there at the bottom. I'm using COMEX GC1, 1970 an ounce, John, up $45 on COMEX gold. So that's a real indicator there. You know, John, just to get started on this week, the single thing I'd focus on is the resiliency of the corporate economy, given the political overlay. I can honestly say I was thunderstruck, John, last night at the Republican battle that Mr. Meadows, Mr. Mnuchin, and Senator McConnell are doing.
I couldn't agree more. Up 16 on the S&P 500. We're positive 0.5%. The conversation begins this morning with Eric Stein, Eden Vance co-director of Global Income. Eric, let's start the conversation right now. Equities just shifting higher, even though the world around us is becoming increasingly uncertain. Why?
Well, first off, Jonathan, thanks for having me on, and good morning. I think it's something, Tom Keene just mentioned. Real yields in the U.S., negative 92 basis points. So if real yields are going to be negative, you have a weaker dollar, gold going up, kind of, global liquidity coming back, even though there's obviously massive problems in the real economy, political issues that you guys hit on in your intro. And so that helps the corporate sector broadly. And then obviously you have the tech part of the equity market, which is, almost like its own sector in and of itself.
The weekend fear, Eric, is that it's like November of 2000. We're setting ourselves up for the agony of March of 2001. Do we slide through this odd bond market? Can equities adjust and adapt in a measured way? Or are you at Eaton Vance worried about a jump condition to something ugly?
Great question, Tom. Me and my colleagues.
You better like it. It's my only good one this week. That's
good. It's a good way to start Monday morning. But me and my colleagues at Eaton Vance, we're typically more focused on kind of micro credit markets or micro fixed income markets than broad prognostications on the market writ large. But I will say that I think this disconnect between Wall Street and Main Street, so to speak, can continue for some time, just given the liquidity out there and given what the Fed is doing. And I also think when people point point to the fixed income market and say, look, treasury yields are low, that must mean that equities can't go up because something bad's happening. That's part of it. But again, if the Fed's providing liquidity and that discount rate that you're discounting cash flows back is quite low and negative in real terms, you can keep markets, higher for longer than many would expect.
John, I'm absolutely fascinated. And of course, I do this with the idea of the nascent reappearance of the real yield with John Farrow. Look for that weekends here at Bloomberg TV. John, I look at the 2-10 spread, and a break below 40 basis points there would be resounding to the equity markets.
Well, Tom, I think
particularly the banks.
The Fed decision later this week is really, really important. The Fed has already told us, Governor Brainerd, that we would move from stabilization to accommodation. I don't even know what that means at this point, Tom, given the amount of stimulus we've seen over the last couple of months.
John, I'm tearing up. I mean, the team gets the 2-10 spread up there like it's nothing. I mean, you can see, folks, the deterioration there. On radio right now, all you need to know is a curve is flatter, and that's not good for James Dimon. John, help Eric Stein out.
43 basis points on 2s10s, Eric. It's absolutely critical going forward. It's nothing to do with the 2-year. That's anchored. It's going nowhere. It's all about 10s and the longer end of the curve. Are you fighting the Fed if you're looking for a steeper curve?
Look, I don't think the Fed necessarily wants a lot flatter curve. I don't think they want a super steep curve, either just from a rate perspective. But I agree with the previous comment you mentioned, alluding to Jamie Dimon. The steepness of the curve does affect the banking sector. So I do think that, as the curve flattens, the Fed actually gets concerned about that. That's actually, a big debate I have with my colleagues at Eaton Vance. But I've been clearly on the side that the yield curve does mean something. It's not the end all. And clearly we're in, markets that are heavily manipulated by the Fed, but on a day-to-day basis, I think the steepness of the yield curve means something, and I think the Fed thinks that it means something.
Well, Eric, jump to Wednesday. What does it mean for Chairman Powell this Wednesday?
So I think he's going to allude to, this transition, and you just mentioned this, Jonathan, on, Governor Brainerd's comments previously, that kind of transitioning from market functioning and stabilization to stimulus. I agree with you. Who knows what that means with negative real yields, but I do think the Fed's going to have more open-ended QE, more thresholds before they raise rates. They seem to poo-poo yield curve control, but who knows if that comes back in. But I think we're transitioning. If you look where markets are, the markets don't need the Fed's help anymore. It's the real economy that needs the Fed's help
Eric,
right now.
What are you seeing at flows at Eaton Vance, folks? Let's remind ourselves that Eaton Vance is a venerable house. They own tax-managed excellence in mutual funds. Eric, what are people actually doing with their money?
Yeah, look, and thanks for the plug, Tom. Look, I think on the Eaton Vance Management fixed income side, I think of us as really experts in credit markets, so corporate credit, securitized credit, sovereign credit, muni credit. I do think investors are looking for yield, whether they're finding that in high-yield bonds, floating rate loans, emerging market debt, things like that. People are looking for yield where, if you get negative yields on real yields in treasuries and very low yields in nominal treasuries, I think investors need to find yield elsewhere, and that's what we're seeing right now.
What does a destabilized dollar, a weak U.S. dollar, do to that lovely EM debt?
It actually helps it. So if it's EM debt denominated in emerging market local currencies, it's actually a positive right off the bat that you get strength in those currencies. So as a dollar-denominated investor, you're making money right there. If you're investing in emerging market debt denominated in U.S. dollars, there's no effect on day one, but it actually makes it easier for the emerging market countries, of which there's some real stress on these countries, given what's going on with COVID. It makes it cheaper for them to pay back that dollar debt. So it doesn't help you day one, but it actually probably makes those countries slightly more creditworthy with a weak dollar. So a weak dollar is good for emerging market investing for sure.
Do you think the world needs a weaker dollar, Eric?
Yeah, no, John, great question. You go back to the Shanghai Accord in, I think, early 2016, the supposed Shanghai Accord, where after the dollar was strengthening, and there was this, talk of kind of trying to get a weaker dollar. I do think a weaker dollar helps. It makes it easier, as I said before, for emerging market countries to pay back dollar debt, for corporations around the world that have U.S. dollar debt. So a weakening dollar is kind of, easier global financial market conditions, easier global liquidity conditions. So I certainly think, global policymakers would much rather a weaker dollar than a stronger dollar.
Well, let's talk about which policymakers, because if you head over to the ECB right now, I imagine a rate of change on euro dollar isn't going to be a good thing for them anytime soon, Eric. 117 on euro dollar, and it's not just euro dollar, it's euro China breaking out as well. Is there a threshold there for you where you think the ECB starts to sound the alarm on a euro moving too quickly?
Yeah, so good point on the euro China. I do think that ECB doesn't just look at the euro versus the dollar, look at the euro broadly. And you're right, with the yuan kind of underperforming, it's still stronger this morning, but it's underperformed other currencies in this recent round of dollar weakness. I don't think the ECB see a strong euro versus everything else, too strong of a euro. But you can argue, given that Europe is doing better than the U.S. right now from a virus perspective, and also given the EU recovery fund, and yes, there are going to be challenges with that, but from a European perspective, certainly there's been more coordination and more cohesion than we've seen previously. So to the extent that there was a risk premia in the euro on a potential breakup, that's obviously significantly lessened now. So I think the ECB will take that. Would they want to see, euro up 10, 15% and inflation expectations commensurately come down? No, they wouldn't want to see that.
Eric Stein, send our best to the team, won't you? Great to catch up with you, sir. Eric Stein there of Eden Vance. Let's sit on the FX market, Tom. Euro-dollar breaking out, dollar-yen breaking down, 105 handle on dollar-yen. These tight trading ranges, Tom, we've been sat in for the last couple of months. We're breaking out into the downside on dollar-yen. On Treasury yields, the same thing on a 10-year, really sticky, in and around 60 basis points. A move to the downside on Friday. It continues this morning, Tom. We're down by 2 basis points on a 10-year to 0.57%.
The dollar legs down right now. DXY, that blended major trading index, legs down right now, well under a 94 as well. John, I totally take your point on the constraint of stronger euro. Anytime you get a big move like this, there's got to be a set of mystery constraints. And right now, front and center for me is a constraint of a 118 print on euro. And as you mentioned, John, the rate of change there, the speed of getting out to George Saravelis' 120 has got to have attention of Madame Lagarde, Benoit Cœuré, and the rest.
And Tom, front and center for everyone down in Washington, D.C. What on earth are we doing down in Washington right now? We finally have an agreement between Republicans. When do we get one between Republicans and Democrats?
It was a relief with Eric Stein to avoid it for 20 minutes. But let's be clear, folks, worldwide and across this nation, on Bloomberg Radio and Bloomberg Television, John, there is no other story this morning. I was thunderstruck at Senator McConnell's comment of in the next few weeks. I have no idea how they get out to the next few weeks.
I think they tightened up the message last night, and a good job too, Tom. I think we'd have a very different equity market. We'll catch up with Kevin Cirilli of Washington, D.C. very shortly on this program, and later a conversation you don't want to miss with Henrietta Trays of Vader Partners from New York City this morning. Good morning. Lisa Abramowitz will be back with us tomorrow. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Senate Majority Leader Mitch McConnell today unveils latest Republican coronavirus relief package. The White House plans to cut the weekly $600 unemployment boost to about 70% of pre-pandemic wages. House Speaker Nancy Pelosi panned that proposal. Democrats passed their plan a couple of months ago. Health officials around the world are getting a reminder of how tough it is to permanently stamp out the coronavirus. They're now grappling with second waves of the pandemic. China reported the most cases since mid-March, and Spain is scrambling to stay ahead of new outbreaks that led the UK to impose a quarantine on travelers from there. This week, Federal Reserve Chairman Jerome Powell is expected to reinforce his message that interest rates will stay near zero for a long while. Policymakers open their two-day meeting tomorrow. The last time they met in early June, the daily count of coronavirus cases had stabilized. Big states like Texas, Florida, and California had yet to see the surges that have afflicted them since then. And America's biggest tech companies have gone on a buying spree this year. The number of acquisitions by Amazon, Apple, Google, Facebook, and Microsoft have come at the fastest pace since 2015. That's despite stepped-up antitrust scrutiny under the Trump administration. Critics say the tech giants are beefing up their power by snatching up rivals. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Original unemployment benefits actually paid people to stay home, and actually a lot of people got more money staying at home than they would going back to work. And so the president's been very clear. Our Republican senators have been very clear. We're not going to extend that provision.
White House Chief of Staff there, Mark Meadows, on the fiscal steps to take place down in Washington, D.C. this week. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramovich taking a well-earned day off. Here's your price action this Monday morning. 2 hours and 12 minutes away from the opening bell. Equity futures higher by 14 on the S&P, up by 0.4%. Euro dollar with a 117 handle. The dollar, the weakest level going back to 2018. And the bond market yields lower by a single basis point. And there it is, spot gold, just 5 trading days separating 1,800 and 1,900, 1966, Tom Keene, in this commodity market right now. A little bit later, Tom, we shift away from the market. The focus has got to be on Washington, D.C., 4:30 local time.
Yeah.
The big reveal.
That's going to be the big reveal, and I'll tell you, over the weekend, the chaos involved, all wrapped around the calendar. Kevin Cirilli is Bloomberg chief Washington calendar correspondent. He's here on July 27th to try to get us to August 1st or August 3rd when the rent is due. Kevin, Ella Coates in the New York Times on Friday, I had a beverage of my choice in my hands, and I put out her dissertation on $600 a week. Here's the summary. Below a certain income level, it's a free lunch. I get that. And above a certain level, it's a huge salvation to the lower working middle class in this country. Why do Republicans want to bury the lower middle class? Because a fair amount of people are getting a free lunch.
Well, you heard this from Mark Meadows, President's Chief of Staff, on the Sunday shows over the weekend, but you've also heard it over the past couple of months, Tom, from members at the Labor Department. It started as quiet conversations, and now, quite frankly, it's larger conversations that are being had, which is that some individuals are making more on unemployment, according to the Republican argument, than they would be if they went back to work. So that's why Republicans are saying that they want to encourage companies to be able to welcome back their employees, because in the longer term, Republicans say that that's going to make more economic sense. Democrats are saying it's not enough money.
Why the reticence on state and local aid, which I believe some would go to Republicans?
Well, I think that even right now, I think that the way that the unemployment benefits had not been issued to individuals who are living without homes, that individuals who are not registered in various other systems, many millions of Americans in the underserved communities haven't received any financial assistance. So there's that issue as well. Democrats are saying that 70% of the $600 is not enough cash. And I think that you're going to have this fight again come the fall, when the next round of stimulus is likely going to be needed, because President Trump is already suggesting that this is not going to be the last round of stimulus between now and the election.
But Kevin, this is not just about size, it's about policy process and execution. Execution's absolutely immense right now. That has got to be the key issue down in Washington, D.C. In the UK, they also have a furlough scheme. It's 80% of wages to a certain cap, plays out through to October. But they don't have to roll out that policy across multiple state offices. If you go forward with the Republican idea of 70% of wages, how do you execute that cleanly in the coming months?
Well, that's that. There are so many process questions in terms of how to execute that, because even from a broader standpoint, it's the smaller businesses. Many of these individuals who are in need, Jonathan, of this economic relief in terms of the unemployment benefits are employees of small businesses. And we've seen and we've had this conversation that based upon reporting here at Bloomberg and elsewhere, that small and medium-sized companies were not able to get the economic relief in real time. And so I think that what I'll be looking for once the proposal is finally unveiled today by Leader McConnell and President Trump is what is the Republican solution in order to making sure that those smaller sized businesses get access to that capital just as quickly as big businesses.
Hey, Tom, Republican leadership tightened up the message going into last night. We're all on the same page. Happy days. We've got a deal between ourselves. We'll negotiate. Senator Graham on Fox News, half the Republicans are going to vote no. Isn't that the story here? Do we have an agreement, or do we not have an agreement?
Well said, and this is the reaffirmation of the Tea Party. Kevin Cirilli, is this the reaffirmation of the Tea Party, or as Greg Valliere says, the president's going to step in with a vengeance? Which is it?
Both.
Both. You can't say that on surveillance.
No, you can't. Hey, here's why. Here's why, Tom. I'm not trying to play both sides here, but listen, here's why. Because come 2024, when we've got the deficit through the roof, breaking the charge, breaking the terminal, what's going to happen is some Republicans are going to be able to need to say that they were against spending more money.
Okay,
but what's happening on the right is the same thing that's happening on the left in terms of government assistance.
Come on, they're going to do this announcement. You're going to go to your massive property, Sound On. You're going to have some guest on there going, and all this comes down to is Republicans lose the House, lose the Senate, lose the White House. And does President Trump have the strength and power now to sit the crew down and say, no, this is the way we're going to do it?
You know, I was struck by a comment that President Trump made within the last 10 days in which he said that phase one execution of the U.S.-China trade deal was something that wasn't necessarily anymore on the top of his radar. It really showed the coming shift in terms of how the president is listening to people like Kellyanne Conway, a senior counselor to the president who has been advising the president to change his tone as it relates to the pandemic, but also as it relates to the economy. We're in the election season now, and I think that the subtle shift in tone, whether it's on the U.S. and China relations or in terms of saying, hey, it's time for America to get back to work, is going to continue.
John, do you see how Cirilli's different now that we're 99 days away? He changes.
He's becoming more diplomatic and focused ahead of November. Kevin, just a final one from me. What does it speak to this moment, the fact that $1 trillion in Washington now is considered too small?
The same thing that Tom just pointed to, Jonathan, which is that there's going to be a deficit conversation between now and 2024. November 4th, not November 3rd, November 4th. Get ready, because that fight's coming.
Hey, Kevin, looking forward to the coverage with you, sir. Kevin's really down in Washington, D.C. Tom Keene, 99 days out. I think just many people, especially market participants that we all speak to on any given day, refuse to believe that the president is going to allow his party to go small on this 99 days out from the election.
I agree with it. I mean, I'm to the point where I would say presidential power comes in here and there's an attitude adjustment getting the number up. But this idea, John, of a partial or a itty-bitty kind of program versus a Democrats' larger all-in-vision, that will be the key talking point.
Well, Tom, I think you can have this philosophical conversation that you should earn more in work than out of work, but there's a trade-off, and we've talked about it. If you don't do something large to offset the shocks to income, the high levels of unemployment that will persist through year-end, this economy and consumption that's held up pretty well considering, it's going to get hit.
I go back to percent of GDP, and the trillions of dollars we're putting out as a percent of GDP is historic, yes. more than World War II. But, John, it's still that. It's just a percent of GDP, and frankly, Europe's going to have the same discussion.
We'll head down to Washington next and catch up with Henrietta Trays of Vader Partners. Should we get you some price action?
Yes.
2 hours at around about 5 minutes out from the opening bell in New York City. Equity futures stretching its legs a little bit, up 14 points on the S&P. We're up by around about 0.4%. Euro dollar comfortably through 117 at 117.25. And spot gold, there's your record high, 1942. Up 2 percentage points. From New York City this morning, good morning. This is Bloomberg Surveillance.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio. Lisa Abramowitz will be back with us tomorrow alongside Tom Keene. I'm Jonathan Ferro. 2 hours away from the cash open. Here's the price action in the equity market. After a mild move lower in equities last week, a lift this Monday morning, up 15 on the S&P, up 0.5%. Yields lower on a 10-year to 0.58%. The dollar breaking down over the last couple of weeks. The euro breaking out 117.26. So look at the gold price just quickly, Tom. I call it the misery trade. 10 years of misery, then every decade you get to say, I told you so.
Yeah.
This Monday morning, for the gold bug, it's I told you so.
Right now, it's I told you so for Dennis Gartman. Major shout out. Jeff Curry at Goldman Sachs, I'll give some major credit to out front on this long ago and far away. But Gartman and yen and euro has been absolutely brilliant. John, we're talking about all this politics, but the reality is you have to go down to Marble Hall. You know, they're in the halls and they're in the Russell building in Rayburn and all that. And the bottom line is they have to commit policy. It would be nice to somebody that actually understands those dynamics within the hallways of Congress.
Not just the agreement, it's about the execution. Let's bring in Henrietta Trey, shall we? Veda Partners Director of Economic Policy Research. Henrietta, great to get you with us on the program. The Republicans are coming to some kind of agreement about 70% of wages for enhanced unemployment benefits. Is this something that state offices can actually execute if this is agreed down in Washington?
It is not. Thank you very much for having me this morning, guys. We heard at our conference about a week and a half ago from every office, Democrat and Republican, that not only does the federal level Department of Labor not have the bandwidth to calculate 70% of an employee's wages for 31 million people, but the state level delays would be completely blown out of potentially even the entire month of August. So if you're talking about just getting the checks out the door, doing this math, wouldn't be a delay of 1 to 3 weeks. It could be a delay of 5 to 7 weeks, depending on which states you're in, how populated they are, how much their unemployment rate is. Getting these 70% thresholds transcribed into policy is not realistic.
Right.
And the policy needs to be dropped.
Okay, Henrietta, Ella Katz in the New York Times on Friday did an absolutely spectacular job on the dynamics of $600 a week. I'm quoting directly from it, folks. Someone making $35,000 a year makes $944 a week, benefits all in that. I get that's untenable to conservative Republicans. Are they going to take everybody else in the working class down with them as they try to not give a free lunch to the poor people?
I think the main question there is how many Republicans are you talking about? At the beginning of this process, maybe a month and a half ago, I was advised that there were maybe 10 to 13 Republicans in the Senate who wouldn't be voting for this bill. That number is now somewhere in the range of 30 to 35 Republicans. That means that the Republican caucus itself inside the Senate doesn't have a consensus over this policy. So when they roll out a package later on today, which is our hope, around 4:30. We were, expecting that on Thursday as well, and also the Monday before that. But hopefully today we get one. You're not going to get a united caucus front because there are about 30 votes that will never materialize, whether it's 70% or not.
Is President Trump dealing with a nascent or new, original, maybe a brand new Tea Party?
Honestly, I think a lot of this is because you don't have a consistent message from the administration. The president focused on two untenable policies for the last 2 weeks, the payroll tax cut and a meal expensing deduction, neither of which Republicans want to endorse. So I don't necessarily want to say this is the problem, to have a conservative uprising in the deficit matters. The issue is that there's no sense of leadership and there's no firm set policy that they can all rally around. Everybody, or a majority of folks, hate this bill. So no matter what comes out, it will not pass.
Henrietta, let's not let this slip under the radar. This is massive. Are you telling us that at 4:30 Eastern, when this is revealed, they're not just negotiating with Democrats, they're still negotiating with themselves?
Absolutely, and you can tell because they don't know how many bills they're going to put out yet. They're going to have one top-line document that walks through a lot of the stuff that we got on Thursday of last week, which includes, parameters for business liability and unemployment insurance benefits and a back-to-work bonus and some hospital and school funding. That's all fine and well, but the plan is still to then separate the package into at least 5 other pieces and do them all piecemeal. So you can tell when they don't have a process plan, they don't have a fundamental policy plan.
Well, let me ask the obvious question, Henrietta. How on earth do the Democrats negotiate with the Republicans if they haven't come to an agreement within the party?
Well, that's the problem, is that right now there are no Democratic-Republican negotiations. It's all intra-party. So Dems get to just sit back and say, look, we've had our HEROES Act, which is what Police Pelosi has been doing for the last several weeks, saying, we're ready to go. They don't have to start negotiations. I had been optimistic that July 31st would have been a hard and fast deadline, the foreclosure, eviction changes coming, but none of that's moving the needle. I don't think we get this bill until August 6th at the earliest.
It's thrilled you're with us on Bloomberg Radio and Bloomberg Television this morning. John Farrow and Tom Keene, Lisa off today. And with us, Henrietta Trey's Aveda Partners, as we dive into some of this politics, hugely influential on this Monday. Futures up 17. Henrietta, real simply here, help me with a calendar. To amateurs like us, it's July 27, and for everybody out my fancy window in New York, the rent is due, and many people, including in my building, can't pay it. Do they get that in Washington?
I don't think so, and I've heard that directly from staff, is that there's this feeling of being out of touch. A good example is obviously the foreclosures and evictions component you're talking about, but one of the ones that really strikes me is the not having a plan for going back to school that's consistent. You know, if you're going to be focused on the economy, you need to have a plan in place that allows parents to send their kids to school. There's no sense of urgency there, so it's a pretty widespread disarray.
How? On August 1st, August 3rd, and that's far nearer than Mr. McConnell's weeks, how are parents supposed to worry about school if X percent, you know better than me, X percent of the people, again, can't pay the rent?
Exactly. And you just have to tier your problems and figure out which one's the most urgent. That's part of why you had a flat top line $600 unemployment provision, just to get a flat line number out the door to help cover some of these issues. Negotiate with your landlord, try to work out some sort of a rent deal, assume that there's going to be another moratorium on evictions. The issue with D.C. is that they're very comfortable passing retroactive policy. And that's something that creates a lack of urgency in D.C. So if I know as a senator that I can pass retroactive unemployment insurance benefits, getting you a $600 or whatever check for 2 weeks if we allow it to lapse, that creates a scenario in which, in your mind, as a senator, you maybe have until August 14th to pass the bill.
And we can feel it already building, the blame game down in Washington, D.C., and the blame game's going to ramp up from here through this week. A bastion of stability for this president is how he polls on the economy. Is that at risk right now?
I think the polls are showing you that that's at risk. He's declined steadily since May, across, including the battleground districts, where he's down by about 6 points in those top 6 states. So I think it's a very consistent message that coronavirus is your number one concern, and the economy is number 2. And the coronavirus issue trumps the economy issue, and you can't fix the economy until you have some sort of a vaccine or at least a comprehensive plan in place to lock it down. And the COVID fix still comes second to a lot of the economic policies they're talking about in this next stimulus bill. So that creates just a circular feedback loop of, well, if you can't handle COVID, you can't handle the economy.
Tom, this was always the risk coming into August. The electorate had managed to split the two ideas, handling the pandemic and handling the economy. The president polling really badly on handling the pandemic, handling the economy polling well. We've got to a point now, I think, where slowly the electorate has started to conflate the two ideas. If you can't handle the pandemic, you won't be able to drive a recovery in the economy.
And this goes back, John, to the V-shape. I mean, the V-shape has disappeared. Michael Feroli at J.P. Morgan, I thought, was exceptionally sharp about J.P. Morgan has to wait for the present data to come in to have an understanding of what happened to the V. And that's where we all are, including, to be fair, the politicians don't know what Q3 looks like. So the answer is ugly.
Talk to us about this, the blame China game that's been played. There are real reasons to address issues with the Chinese Communist Party. But blaming China, I just wonder if that is a decent enough excuse going into this election come November.
I think it's a really good political strategy. If you can get 63 to 73% of Americans to agree that water is wet, you're having a good day. And that's how many people agree that China is a nefarious actor for whatever reason, whether it's COVID or intellectual property theft. So I think the president is making a really well-calculated risk. I also think that there's little chance that the Biden administration or campaign, rather, would try to skewer his policies and say, oh, actually, we want to stand up for China and maybe not be so bullish and don't close the consulate. I don't see the Biden campaign trying to step out in front of any of those daggers. The real question for anybody really watching the U.S.-China trade war is to see what the president is doing on economic policy. Is he imposing secondary sanctions on PRC banks? No. Is he putting aggressive sanctions on more than just a couple of Chinese officials? No. Is the prospect of tariff increases rising? No. And those are the real things. So I think what we're seeing right now is very political, very window dressing-esque. Of course, it's a big deal, and any other year it would be top of mind and all I could talk about. But this year, as long as it's not associated with tariffs or expanding sanctions, I don't think it risks a phase one trade deal. And I furthermore believe it underscores our point that has been for a long time now. You can't risk losing the votes in the heartland, in Kansas, in Iowa, North Carolina, Georgia. You can't risk those Senate seats or those electoral college votes.
Henrietta, just tremendous. Great to catch up with you. Henrietta Trace there, Veda Partners Director of Economic Policy Research. Tom, I call this the election put. The idea that for the president there is a huge incentive to go bigger than $1 trillion, a huge incentive to take away the arguments from the Democrats, kick the legs away from them, going into August, September, October, November.
No, there's no question about it. It's just a question, are we going to see it this afternoon or do we see it in the week? But the last 3 days have been, I think, for many, many people in the middle, both Republicans and Democrats, absolutely shocking. You know, Henrietta sat there, talked about how the Republicans have to finish strong. John, I have to point out the Tots finished strong, even with that tie against Crystal Palace. I mean, come on, Europa and all that, the Tots finished strong here.
Do you feel
out of the only sport that actually operated.
Do you feel good about being in Europe but being in the Europa League, Tom?
I'm all I wouldn't know the Europa
League. Do you understand the
League
nuance?
Yeah, I wouldn't know the Europa League if it hit me over the head. But you know what, John, to the credit of the Premier League, at least they played.
They got it done.
We can't even seem to get going here on sports in America.
Season finished. Tom Keene, the only man in America who watched Spurs Crystal Palace over the weekend from New York City this morning. Good morning.
Harry.
Alongside Tom Keene, who's very excited about the Europa League. Google it if you don't understand it. Coming up on the program, Lawrence Gostin, Georgetown University professor from New York City this morning. A good morning to you all. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Today, Senate Majority Leader Mitch McConnell is expected to release a $1 trillion coronavirus relief package. That sets the stage for talks with House Democrats, who passed their relief bill a couple of months ago. The Republican proposal would extend supplemental unemployment benefits, but at a lower level. It would also provide another round of $1,200 direct stimulus checks. White House economic advisor Larry Kudlow insists the U.S. economy is still set for a third quarter recovery. Kudlow said on CNN that the virus surge in Sunbelt states will have a limited impact on the rebound. He's predicting a 20% growth rate in the second half of the year. And Spain and 2 British airlines are blasting Prime Minister Boris Johnson's virus quarantine over the weekend. The British government ordered a 2-week quarantine for travellers from Spain. That's the UK's top tourist destination. British Airways and EasyJet called it another blow to British vacationers. And the supply chain to save the world is unprepared for a vaccine. Industries that ship goods around the world say they aren't ready for the challenges of getting a coronavirus vaccine from drug makers to billions of people. Freight companies already are stretched thin from the pandemic. They would face problems ranging from shrinking capacity on ships and aircraft to cumbersome paperwork. And Bitcoin rose above $10,000 for the first time in 6 weeks. Fans of the largest cryptocurrency have called it digital gold. It's in favor as concerns rise about the health of the world economy. Last week, regulators said that U.S. banks can provide custody services for customers' crypto assets. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This was that crisis, and that's what we delivered with a 15+% ROE. So I think it validates the strategy, but it's our strategy. It's not for everybody. This is what we chose. We didn't want to be credit heavy. We want to be flow-based, fee-based, asset-based.
Don't deny that some of these hotspot states are going to moderate that recovery, but on the whole, the picture is very positive, and I still think the V-shaped recovery is in place, and I still think, Jake, there's going to be 20% growth rate in the third and fourth quarters.
National Economic Council Director there, Larry Kudlow, speaking to CNN over the weekend alongside Tom Keene. I'm Jonathan Ferro. Lisa Brown is back with us tomorrow. Tom Keene, let's give Larry some credit on one thing, Q3. Most economists on Wall Street agree with him that Q3 will be a bounce back somewhere in the region of 20%, maybe a little bit lower at 18. The disagreement is Q4. Most people just assume that the mechanical lift that you get from shutdown to reopen plays out and then fades quickly, and we're already seeing that. On top of that, another layer is the fact that we're seeing the tension across the Sun Belt, and consumers and businesses there have pulled back. That's where the disagreement is with the administration and the data people on Wall Street, at least, expect to see.
And Kudlow knows this with his work at Bear Stearns a million years ago. John, it's real simple. We've got some confusion in job economy, and for the politicians, it's all about jobs. This confusion of furlough, layoff, and the rest of it. And the jobs report here, I believe it's August 7th, is going to be extraordinarily important.
Tom, Bob Prince of Bridgewater said exactly this. We have a huge problem with a duration mismatch. This pandemic, this episode, this weakness in the economy is going to last a long time.
Yeah.
We keep applying 3-month, 4-month fiscal policy band-aids, and every time we revisit the new one, the collective will fades. And Tom, that's the issue. We're trying to put a new band-aid on the economy, and you can already see the collective will fading.
There's no question about it. I mean, and again, the political overlay that we've covered in the last half hour, we're going to do the virus here. But, John, I think you're going to see it in the markets. And I'm just looking at the low-yield regime we have, which signals slowdown in aggregate demand. There's no other way to put it.
Well, Tom, you don't see it in the markets right now. Equity futures higher by about 18 points on the S&P 500. We advanced there. Yields getting sucked lower, down by a basis point at 0.58%. Real yields, a big issue. We'll talk about that a little bit later with James Sweeney of Credit Suisse at about 8:30 Eastern. But there's the move in the gold market. Spot gold, Tom. Real yields lower, gold breaking out. And the move from 18 to 1900 has been so quick, so fast. Just 5 trading days to fill that gap, up 2% in today's session.
Right now, John, let's look at the virus, but look at it in a different way. There are very few professors that can write a textbook that sells like crazy, and then there's very few that can make it a global classic text. Lawrence Gostin's Global Health Law is the only book on the matter. He owns the high ground, and we're honored that Professor Gostin of Georgetown could join us this morning. Are we becoming, in this pandemic, sir, more European? Are we speeding up somehow our evolution away from the health law that we used to do to a more European model more rapidly?
Well, that's a really great question. I mean, the conversation in America, I've never seen more European about the ideas of equity, that we all have to have accessible, affordable health care. There's a lot of discussion about, vaccines, and that we need to make sure that everybody gets them. But we're a long, long way from Europe. I mean, I've lived under many of the European systems of their health systems. They're very different from the one that we have now. We still have large numbers of people that can't access healthcare, large inequities. So, the conversation is one thing, but the actual reality on the ground is quite another.
What have you learned in this pandemic? What has surprised you as the global expert on not only our health law, but frankly, sir, our health system?
Yeah, you know what the really interesting thing is that I wrote the Model Emergency Health Powers Act after 9/11 and the anthrax attacks. And most of what I'm seeing now is really what I expected. Devastated economies, devastated social structures, quarantines. But I couldn't have ever imagined, nor could my team have ever imagined, that you would actually have lockdowns of major cities around the world, New York, London, Beijing. It was really, quite astounding, the level, the sheer audacity of this pandemic.
You and I studied the giant Uwe Reinhardt's work at Princeton. He is terribly missed each and every day, but he brought a European prism to American medicine. I want you to speak now to the AMA. I want you to speak to a more Republican, Lockean, individualistic doctor out there about what's to change. How will America change to the vicinity of what Dr. Reinhardt proposed?
Yeah, I think we can actually do this. I've been, talking about these proposals in Congress and among the presidential campaigns. I think that, if we really enhance the Affordable Care Act, number one. Number two, we expanded Medicaid. And number three, one of the things that we're not talking about on the political scene yet, but we shouldn't be talking necessarily about Medicare for all, because I just don't think it's going to happen in the United States. Would it be good? Yeah, I think it'd be great, but it's not going to happen. What about Medicare for children? 0 to 18, say. It would be dirt cheap because kids are really, really healthy. It would sow the next generation. It would help us in education. It would help parents. It seems to me it's a no-brainer. So I think we can fix the U.S. system. It won't be as good as the European system. It just won't. But it'll be darn good if we just double down on the kinds of programs that we actually have now.
Professor, we have about 60 seconds left, so forgive me for making this a short one for you. In my conversations with family and friends, we talk about the return to normal. I'm just wondering what that conversation looks like now in the professional community that you're a part of.
Yeah, the return to normal, I'm asked that question all the time, and it occurred to me that I actually do know the answer, even though I didn't think I did. Just look at the history. Basically, the history tells us that, from the influenza pandemic of 1918 and many others, it'll probably have a 2 to 3 year duration. And then the virus won't go away. So I would say, we're 6 months into this, another, say, a year and a half. I think we'll really start to pull ourselves out of it. And, it won't go away, but what we'll do is we'll have a vaccine that will be partially effective. We'll have treatments, and we'll have some natural immunity. So we're going to kind of learn to live with this virus, and that's what I think our future is going to be like. But one of the things I just want to end with, do you know what happened after the great influenza pandemic of 1918? It was actually the Roaring 20s. Everybody got back together. We were all social animals.
Well, let's hope the 30s don't follow the roaring 20s. Professor, fantastic to catch up with you, sir. Lawrence Gostin there, Georgetown University professor, on this economy and getting back to normal with this pandemic. Tom, it is the critical question, the return to normal. And I think the professor puts it right. We've got to learn to live with it. That's the huge challenge for the next 18 months.
It's a huge challenge, and of course, the uproar this weekend that no vaccine will do it. We've been, with the experts we've talked to, John, it's very clear there's going to be a set of vaccines, booster shots, however that works out. But the setup that we have here is to get into 2021.
Equity futures this morning, positive from New York this morning. Good morning. Up next on the program, Alicia Levine of BNY Mellon. That's next right here on Bloomberg.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Markets don't like uncertainty, these binary risks which are impossible to hedge. with an equity market near its highs, I think buying some treasuries for safe haven makes sense here.
It's very difficult to imagine when and how the Fed's going to start hiking. Now, never say never, but we're looking many, many years into the future.
I don't think we're going backwards. I just think we're slowing down and we're going to level off in terms of the recovery.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. John Farrow and Tom Keene. Lisa Abramowitz off today. Just there before Mohammed El-Arian, Stephen Major of HSBC, along with a whole bunch of other smart people, said lower for longer. And John Farrow, that's the message this morning. Futures up 19. But to me, the story is the bond market. And as you know, those huge negative and persistent real yields.
We're breaking out of recent ranges, Tom, on a range of assets and securities. I think it's interesting to see dollar-yen break down, to see treasuries firmer, gold breakout, yet still equities are firmer on the day. Equity futures up by 19. We're up 0.6%. And we do this, Tom, going into a battle down in Washington, D.C. I've said repeatedly over the last couple of weeks, so long as it's just about size, we'll have an agreement. When it shifts into concepts, much, much tougher negotiations. These negotiations, Tom, are now about concepts, not just about size.
That's great, but negotiations means there's a timeline. And, John, I do not believe they have the luxury of a timeline because of the state of the economy, the unemployment dynamics. Again, we'll see that August 7th, along with claims this Thursday as well. But the economic dynamics now, John, don't give you a comfortable August.
They don't. And for House Speaker Nancy Pelosi, there's almost an incentive there right now, Tom, to say we're not negotiating until you finish negotiating with yourselves.
That's understood.
The scope for real tension this week down in Washington, D.C. And right now, Tom, this equity market's not picking up on it.
Well, let's do a data check right now to get us going because there's some real nuances here. John, maybe start off with gold, where we are in gold.
Look at a spot gold breaking out to a record, Tom, through 1900 and nicely so at 1937. Treasury yields down a basis point. We head south on Treasury yields. We've broken out of that sticky range to 0.58%. The lows on a closing basis of the year very much in sight now. Euro dollar, it has just been like a magnet, higher, higher, higher. Through 116 nicely, through 117 comfortably, up 0.75%. And it's that weaker dollar that people anticipated, Tom, that's starting to materialize. Negative real yields starting to bite in foreign exchange.
Yeah, John Farrow with a 1937 on gold there. That's what you do, folks, when Aston Villa is not relegated. I'm at 1962 on COMEX gold, which is a much, much stronger price. So we got a market here, folks, that is extraordinary and a mystery. She's a chief strategist of mystery at BNY Mellon. Alicia Levine joins us. And what's great about Alicia Levine is prodigious academics behind trying to game and guess the view forward. Alicia, thanks so much for joining John and me this morning. Can you buy the marginal share this morning, Alicia?
Yeah, but I think you don't buy it in tech. And, you know, the message from the last couple of weeks was really interesting. The 5 large cap tech stocks over the last 2 weeks were down over 5%, and the rest of the S&P was actually up 5% in the last 2 weeks, suggesting a broadening of the market and the trade moving away from those parabola-like stocks that we've all talked about for the last 4 months.
Well, then you
can.
Okay, but
you can. Yeah.
Well, I don't mean to interrupt, but this is so important. Do you rebalance by selling tech, or do you hold the tech and put new cash to work? Which is it?
I think you have to sell a little tech here. Okay. I think that the growth stocks must remain a core holding and an overall portfolio allocation, simply because going forward, growth will not be strong, will be lower, and so growth tends to outperform. But, you know, if you look at it on a chart basis, these are parabolas. They don't suggest future gains in the near term. So, you know, they've gone too far, too fast. And the forward comments after the quarters has not been matching what the stock prices have done. So I think you pull a little bit out of tech, and that's what we saw in the last couple of weeks. People just sort of shaving, not really dumping, but shaving, and that makes sense, you know, because that's what you do for rebalancing. You sell your winners and you kind of reallocate.
Tom, enlighten me. When was the last time you interrupted someone without meaning to interrupt them?
I think Nixon was president.
Happen?
No, Nixon. Nixon was president.
Go back to Nixon. Yeah. Alicia, I know you're used to it.
Maybe LBJ.
Thanks for being with us this morning.
It's okay. I'm a New Yorker.
I know you can handle it. I'm not worried about you, Alicia, at all, in any way, shape, or form. The rotation away from tech, let's continue that conversation, because a lot of people come on this show, as you know, Alicia, and they talk about rotating out of tech, but into the cyclical areas elsewhere. EM, Asia, China, Europe much more so. Is there an argument to stay US-based?
So I think, look, it's really interesting. Right now, the rest of the world is recovering faster than the U.S. So we see it in the industrial production in China. We saw it in the data coming out of China in the last week, and we saw it last week coming out of Europe in the PMIs. So the rest of the world is recovering faster. The only thing I'll say is that the valuations tend to get higher in the U.S. I think you definitely have to have an allocation to Europe, but the softer dollar does argue for cyclicals here in the U.S. That's going to be the bedrock of support in some of these stocks. I mean, so your softer dollar is helping these multinational companies. And by the way, multinational companies are exposed to the recovery overseas. So, you know, you have to stay in the U.S., but I think Asia is great, and I think Europe looks like a nice trade here.
Well, Alicia, let's continue this conversation then. Is the weaker dollar a symptom of the foreign inflows or a driver of them? How do you frame that for clients at the moment?
Well, that's a really great technical question. Thank you, Jonathan. I think it's a symptom, and it's a symptom because let's go back to first basis, right? First basis is the path of the recovery is going to track the path of the virus, okay? And what we've seen in the last 6 weeks is that the path of the virus is exploding everywhere in the U.S. And so economic activity is flattening. And so it's not happening in other regions of the world. So therefore, they're recovering faster. We're flattening. We saw the first problem in the labor market last Thursday, where the claims data went in the wrong direction for the first time in 16 weeks. So we're going to start feeling it here. And I think the softer dollar is a reflection of that. Not to mention, yields are so low. We've got negative yields, as you were talking about, all morning long. So I think that the weaker dollar is a symptom.
Is dividend and dividend growth a proxy for yield right now?
Yes. Look, you know, it's interesting. Only 62 companies in the S&P have actually cut dividends. I would have thought that would have been more. And it's interesting that they haven't. And part of that is due to the support from the Fed supporting all the different levels of bonds here, you know, creating a situation where you have enough capital and you can still pay dividends, because the number of companies that have cut dividends is actually less than in 2008 and 2009, which I find really interesting. I would not have expected that 3 months ago.
Welcome all of you on Bloomberg Radio, Bloomberg Television. John Farrow and Tom Keene. Alicia Levine with us right now, BNY Mellon. Alicia, what are you seeing people actually do with their money? I'm fascinated when I talk to you or say Liz Ann Saunders at Schwab about what the actual action is of people. What is the action right now?
So the action is very defensive, and that's why we remain cautiously bullish on this market. You know, nervous but bullish, because positioning is defensive. So money market funds, gold, and bonds, and investment-grade bonds, and that's really where the incremental trade is coming from. People are nervous to buy into this market, and as long as you still have that going on, you have support. You know, it's a contrarian, you know, view, and so therefore, you know, you have support under the market. But positioning is defensive.
So, Alicia, let me ask the stupid question: who's buying stocks then?
Look, people are buying. People are still buying stocks. They're just not running into tech in the same way. I mean, the last couple of weeks was a cautionary sign that the valuations do matter ultimately, and you have to take some of the excess out of it. So look, we are seeing buying in equities. It's just the trade is, you know, the incremental trade still is bonds, gold, and fixed income.
Just because we're hermetically sealed here, John and I are in two separate, you know, cubicles to try to.
Yeah, I hope they keep it that way too,
together.
Tom.
Well, you know, that's true.
I can see that. I can see that.
You know, I just did a log chart on Amazon with some fancy moving mathematical averages for Alicia Levine. Come on, Alicia. Amazon, all it's done is fallen back to a very comfortable support. It's not a correction. It's almost like a pause. I mean, do you buy the dip?
Can you buy the dip in the tech stock?
Yeah, I'm asking. I need to make some money here.
So Nasdaq futures are up 0.9%. Where's the dip on Nasdaq the Nasdaq over the last couple of weeks? I know we've come back a bit, but hardly. We're still up near all-time highs, Tom.
I don't know. I'm just trying to impress Alicia with my math, and all I see is on a log chart, Amazon's back to support. I mean, it's not like it's caved in.
Right. No. So, but look, it is 12% off the highs. So, that is not, again, that's not a bad entry point for any stock after you're, 10 to 12% off the highs and that kind of fast mover. That's fine. We don't think these stocks are rolling over. We just think some of the excess has to come out of it. And charting is a great way to pick your entry point.
Alicia.
But, as I've said before, parabolas don't make for great technical charts. You have to wait.
Always enjoy catching up with you.
Geometry
Appreciate your
with
patience
Alicia.
this morning with us as well. Alicia Levine, BNY
What's that
Mellon there.
mean? Are you throwing me shade?
I'm usually saying that to appreciate their tolerance for a certain someone who wears a bow tie
Are
and
you
interrupts a lot.
throwing me some parabolic shade?
Is that new? I do that every day.
Yeah, you do that every day. I love when she's on. We talk, X squared plus Y squared equals 1 or whatever it is.
Big week for tech, Tom. Hearings later this week, then tech earnings later this week. We will hear from Amazon, Apple, and Facebook as well.
Yes.
In your equity market this morning, good morning to you all. Let's get to the price section of the morning, shall we? This Monday, we just come flying out of the gates. We're up 17 on the S&P 500, up 0.5%. If you get cross-asset, just let me give you a quick feel of how things are building up this Monday, because it's actually really, really interesting to see the bond yields come lower, gold start to break out, and the FX market capturing a weaker dollar once again. Euro dollar 117.47. We're up 0.8% on a single currency. A little bit of fuel for that. German business confidence elevated to the highest since 2018. Incidentally, euro dollar the highest since 2018. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz back with us tomorrow. This is Bloomberg Surveillance, heard on Bloomberg Radio, seen on Bloomberg TV.
With the First Word News, I'm Rishka Gupta. Senate Majority Leader Mitch McConnell today unveils the latest Republican coronavirus relief package. The White House plans to cut the weekly $600 unemployment boost to about 70% of pre-pandemic wages. House Speaker Nancy Pelosi panned that proposal. Democrats passed their plan a couple of months ago. Health officials around the world are getting a reminder of how tough it is to permanently stamp out the coronavirus. They're now grappling with second waves of the pandemic. China reported the most cases since mid-March, and Spain is scrambling to stay ahead of new outbreaks that led the UK to impose a quarantine on travelers from there. Chinese authorities have taken over the US consulate in Chengdu following its closure. That's the latest development in the deterioration of relations between the two countries. The US lowered its flag over the consulate just days after forcing China to close its consulate in Houston. This week, Federal Reserve Chairman Jerome Powell is expected to reinforce his message that interest rates will stay near zero for a long while. Policymakers open their two-day meeting tomorrow. The last time they met in early June, the daily count of coronavirus cases had stabilized. Big states like Texas, Florida, and California had yet to see the surges that have afflicted them since then. America's biggest tech companies have gone on a buying spree this year. The number of acquisitions by Amazon, Apple, Google, Facebook, and Microsoft have come at the fastest pace since 2015. That's despite stepped-up antitrust scrutiny under the Trump administration. Critics say the tech giants are beefing up their power by snatching up rivals. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news analysis and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Inflation goal is symmetric, which means we should overshoot it. We're having a difficult time doing that, like all developed economies. I'm supportive of the idea of letting inflation get above 2% before we take any action with respect to the Fed funds rate.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
And Americans understand the concept that you shouldn't be paid more to stay home than to work, that the fair thing is to replace wages, and it just wouldn't be fair to use taxpayer dollars to pay more people to sit home than they would get working and get a job.
Secretary Mnuchin on the fiscal battle emerging in the United States down in Washington. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramovich back with us tomorrow. Tom, this is the debate. Philosophically, I get it. I think everyone understands it. Yep. But in an economy where the unemployed vastly exceeds the jobs open, it's not an argument you can make right now that this is holding back labor supply. You have to understand that more broadly we have an economic issue and we have to offset the shock to income somehow, some way.
Well, but the most important thing, John, is a percent of income idea is a brilliant idea. Ella Kutz in her beautiful work for the New York Times slots in a 70% income idea. The numbers change is clearly fairer, but I believe you and I heard in the last hour it's operationally not possible.
Struggle to execute it. In the UK, we've done a furlough program, Tom, at 80% of your previous wage at a certain cap for a certain amount of months. In the United States, if you want to do this, you have to roll it out across all the different state offices. And to do that, Tom, we've seen even with the $600 enhanced unemployment benefit, we've seen even with that processing problems. Can you imagine the processing issues they would have with something more complex like this?
Well, I don't see it, but we're going to see it through the day. Balance of Power at 12 noon, and then Kevin Cirilli with leadership in the afternoon as well. This is going to be ongoing through the day, and our Bloomberg Washington team is steeled to give you the flavor that we get into Tuesday of this week, and then maybe the Republicans with some form of agreement. Right now, on gold, Michael McGlone joins us. He's with Bloomberg Intelligence. He does really, really smart multiple axis charts of the story behind a given series. Mike McGlone, what's the story behind gold when you do your famous McGlone charts?
Hi, Tom. I'm starting to feel insecure about my multiple axes on my charts. The key thing for gold is it's just getting exciting now. Before, it was just retracing a correction. Now we're really kicking into a new bull market. But we have to use a little bit of caution. On a 50-week basis versus his 50-week average, it's about 20% above that. That's a pretty rich level, so it's a little bit overbought. But big picture, this market's breaking out. It's a new bull market, and it's just a question of time. So maybe we consolidate around 2,000 for a while. It's just probably a question of time you go to the next leg higher, which is 3,000.
Do the ETFs and the intangible securitization of gold, does that change your analysis from a million years ago when you were doing it for Alexander Hamilton?
Couldn't afford to see the play, but I love the book. I think so. It's so much more easier to get the exposure to gold. Persons like me can get into gold for 20 or 30 basis points. You don't have to vault it. You don't have to store it. You don't have to go to the equities. So yes, it's much more easy to get into gold, and I think that's what we're seeing now. Is there's probably a flood of investors going.
Okay, great. But then what? Come on. I mean, John Farrow doesn't know what a Krugerrand is if it hit him over the head. But that's great. But does that mean it's just as easy to get out of gold?
It is. But just like stock market is too, but gold has a little more enduring bull market going in its favor, as we see in a cover of The Economist. Free money, every central bank in the world just absolutely printing money. That's pretty bullish for gold. And then you look at bond yields. Every day I see that 30-year below 140, below 130, 122. There's no competition for gold right now.
I can say, to put the record straight, Tom, my granddad used to own Krugerrands. The bad news, though, is they all got sold a long, long time ago, and we don't have them anymore. Yep. And I'd love to say we still had them, but I'm sure that's a story for a lot of people too, Tom.
Yep. There's no question about that. John, ask a question here on gold. I mean, it's a very British thing.
Well, that's what I plan to do, considering he's here to talk to us about gold. Mike, 2011, we saw this story play out. We're seeing it play out again in 2020 with a similar argument. Why is it different this time?
It's a little bit more enduring. 2011, if you look at the lows from the crisis, 2008 to the peak, gold rallied about 3 times. So to do that, we'd probably have to get to about 4,000. It's just a continuation the way I see it. You have to go back to 2011, the last time gold was more than 20% above its 50-week average, so it's a little bit rich. But this one looks more enduring. When do we have any idea when central banks will start tightening again?
We don't, and isn't that the problem, Tom? Real yields lower, dollar weaker, what you buy? Gold. And we've said repeatedly, Mike, on this program for a long time, the argument against gold was a lack of yield. Guess what? Where do you go for yield right now? Do you think people are getting more comfortable with the gold trade with that in mind, Mike?
Oh, yeah, absolutely. I just look at that long bond, and I only see it gravitating towards zero. And eventually, when we get inflation, gold still is the primary beneficiary. Now, if we just get a little bit more weakness in the dollar, that's a launch pad for gold.
Mike, while we've got you on, I want to segue here from gold over to nat gas. It's probably the one commodity I unfortunately ignore the most, which is my problem. But under a 2.00, what are the dynamics of natural gas forward?
Massive supply, despite rapidly increasing demand. And always the key thing to remember about natural gas is rapidly increasing technologies, increasing that supply, most notably in the U.S. And that's a key reason for deflation in energy, petroleum. Natural gas has just been the leader. So natural gas below 2 should stay there for a while. We might spike, but there's just too much supply.
Is copper affected by the China-U.S. dynamic?
Yes, to me, copper is one of the most vulnerable commodities right now. Looks a little bit expensive. It probably is more likely to trade closer to 5,000 versus 6,500 now, versus getting above 7,000. So copper, to me, short term a little bit supply constrained, but overall it's a bear market. It's been a bear market for almost 10 years.
Mike, just quickly, what's the tell to know when gold is topped? Is it when I start to see those commercials every single day about a company that wants to buy my gold? Is that when we know we've hit it?
I think the key tell, Jonathan, is that at some point, someday, when we get near a nadir of the next bear market in the stock market, which right now is not even on the radar.
Mike, great to catch up with you, sir. Mike McGlone, Bloomberg Intelligence. Tom, do you remember those commercials from 2011, 2010? They just got rolled out repeatedly. Do you think we start recycling
John,
again?
the kids are got the pliers out, and they're trying to get the tooth back here. That's the towel.
Do you want another towel? This is great. This came from Doug Cass this morning. He wrote the following on Twitter, Tom. You'll love this. We all know when Tom Keene starts talking soccer nonsense with Ferro TV, he has already given up on the Boston Red Sox season. Have you already given up on the season?
No, they were 1-2. I haven't looked to see how bad they messed it up yesterday. But, John, it's so strange to have the 3rd week of April in July. Cass is absolutely dead on there. It's out of body to know the season's over the 4th week of April or whatever, except it's stupid. I don't like this.
Well, the English Premier League season's over too, Tom, so you've got to stick with it. You're just going to have to get used to it.
I guess so. I mean, when do they start again? Don't they pick it up?
I think September.
Okay, so they take a month off.
You've got a month or so off. So we get some price action this Monday morning. We shape up as follows here in the United States. Equity futures with a nice lift. I've got to say up 0.5% on the S&P 500. We advanced 17 points. In the bond market, Treasury yields just starting to come lower by a basis point at a 10-year to 0.58%. There's the gold trade we've talked up all morning. Here's the FX trade. In foreign exchange, euro-dollar getting all the attention over the last week, with euro-dollar breaking through 116, then 117 at 117. 117.46. I would say take a look at dollar yen. Tom Keene, dollar yen,
yeah,
105
John,
handle. Just sneaking up on you.
Don't mean to interrupt. Euro Swissy just finally broke down and went where everybody knew it would go. Moments ago, it explodes out to a 108.83. That is a strong euro signal.
Coming up on this program, James Sweeney, chief economist at Credit Suisse, on a big week ahead with a Fed decision coming later this week as well. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
Quand on voit la mort de George Floyd, on image la mort de mon petit frère Adama Traoré. Et la France va dénoncer tout de suite ce qui va se passer aux États-Unis. Nous, dans le combat vérité-justice pour Adama, vraiment dans le court terme, ce qu'on attend et ce qu'on exige surtout, c'est la mise en examen des gendarmes, la condamnation des gendarmes et d'un procès public. Aujourd'hui, on dénonce le déni de justice qui est en France depuis 4 ans. Jamais, on ira jusqu'au bout, ça fait 4 ans que nous sommes là, nous n'avons pas peur. Ils ont les armes, nous sommes devenus des soldats malgré nous. Hein. Face à nous, c'est une machine de guerre qui n'a ni sentiment, ni état d'âme, ni remords. Oui, c'est un mouvement qui se prend, c'est le mouvement du comité Adama, de la nouvelle génération Adama. Aujourd'hui, moi je suis là, nous sommes là, on changera peut-être pas le monde du jour au lendemain, mais on changera des choses.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
From New York City, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio. Lisa Abramov's back with us tomorrow alongside Tom Keene. I'm Jonathan Ferro, 2 hours away, in fact 60 minutes away from your opening bout. A cash open just around the corner. Equity futures drifting higher going into it. Up 17, positive 0.5%. There's the big FX move. Euro dollar out 0.8%. 117.49. You've got to go back to 2018. Tom, do you remember the happy talk of early 2018 about synchronized recognized global growth just before the trade war kicked off.
Yeah.
We're approaching those kind of levels on euro dollar.
No, we are, and you really wonder where the constraint is. I know George Saravelis over at Deutsche Bank's out at 120, among many others. And, it's interesting, John, to see the support breached here on dollar and how that will change the resilient dollar crew. It'll be interesting to see that, like David Bloom at HSBC. You wonder what he'll publish.
Well, Tom, I think he'd stick with it. I actually think that Bloomy over at HSBC would stick with it. So listening to him, he acknowledges that you could get that risk on rotation into currencies like the euro and elsewhere. I think the debate coming from HSBC, just being slightly familiar with it, the argument against the weaker dollar call is the broad-based, sustained structural shift away from a US dollar over a long period of time, not just a short move over the last month or so into year end.
Yeah, no question about it. As I mentioned a couple minutes ago, what's really dynamic here in the last 15 minutes, Euro Swissy has gone strong. Euro weak Swissy just in the last 15 minutes out to a 108 level for global at Wall Street. That's a nice segue over to a Swiss bank. It is Credit Suisse, and they have a wonderful chief economist. His name is James Sweeney, with terrific U.S. and British academics. James Sweeney was brilliant a few years ago, saying the disinflation and deflation gloom of Europe a few years ago was off the mark. He joins us this morning with a different view. James Sweeney, are services going to cave in and join goods as disinflation and deflationary items?
Well, right now, services have joined goods with this collapse in activity, but it's been driven by shutdown. Now we're rebounding because there's some activity turning back on. But I think if you look beyond this rebound, the fears should indeed be toward weaker inflation, including in services, given a very uncertain path for unemployment and potential for pretty elevated unemployment deep into 2021.
How have you adjusted your GDP for the United States of America? Give us a view out 12 months, or dare I say even to the end of this year.
Well, yeah, I mean, again, the rebound is formidable because when you turn the lights off and you turn the lights back on again, it does crazy things to the data. So what we're seeing now is an incremental slowdown in the U.S. because of increasing infections in the summer. But, we're still forecasting a very strong, basically double-digit increase in Q3 GDP. But what you have to remember is that the level of activity is going to be well below trend.
Right.
So, if we have GDP contracting, 5%, 6% this year, right. You've got a big hole to fill.
Help me with a folk trio, McConnell, Mnuchin, and Meadows. I'm sure they're watching right now. James Sweeney, what's the American all-in unemployment rate now, the U6? It's over 20%, isn't it?
Well, that's a fake number because that's telling you about how many hourly workers are getting 0 hours during a period of shutdowns. But I think the real number is probably closer to 10 than 5. And that's a big problem. And in 6 months, even if there's a vaccine around, if that number is still real number is still closer to 10 than 5, then that has real implications for the Fed and for growth and for inflation pressures.
Well, let's talk about the latter one, inflation pressures. As you point out, we'll be below capacity for a sustained period, an extended period of time. Yet, James, there's a conversation drifting into inflation away from disinflation, inflationary expectations starting to pick up. James, from your perspective and your conversations, why?
Yeah, well, it's actually a very popular conversation among equity investors, not so much among debt investors. But the view is basically, M2 money supply in the U.S. is up $3 trillion. Bank credit is up just under $1 trillion. Treasury debt is up, $3 trillion-ish. Fed balance sheet similar. Surely this is inflationary down the road. Not so surely. It's possible, but inflation is a forward-looking phenomenon. It depends on expectations later on. It depends on whether the Fed responds to incipient inflationary pressures. A lot of good things have to happen first in order for us to get there. So I think the focus it needs to be on exactly that European situation that I've been not expecting in the U.S. for a long time. But the odds that inflation gets stuck at a lower level are elevated at the moment. And I think the Fed is going to be focusing on that. And I think we're going to see policy actions over the next 6 months that confirm that fear.
James, we can talk about the policy action in just a moment. Can you just walk through our audience the relationship between money supply and inflation? Just how tight has that relationship been or not over the last 10 years, last 20 years?
Poor, not good. Not a good relationship. And again, with interest rates so low, bonds are not necessarily a great attractive alternative to cash in the bank. So if cash is being created and deposits are being created, I may not want to put those in fixed income securities. I may not want to take the risk of equities, and so the deposits don't go anywhere. I mean, in the short run, it's nice that the stimulus has gotten cash flow into a lot of especially lower income cash constrained workers so that they can pay their bills. That's extremely important. But the idea that this money is going to circulate at a high rate and risk and really grow aggregate demand in a way that will quickly be inflationary seems pretty far-fetched to me.
If you're just joining us, Bloomberg Radio, Bloomberg Television, John Farrow and Tom Keene, James Sweeney with us with Credit Suisse, their chief economist. Lots of really good conversation this morning centering on Washington and our fiscal policy along with markets. Futures up 17, now up 13. James Sweeney, all that's fine. But if I get a James Sweeney economy, what does $4 trillion in debt do to it? I don't understand the dovetail of soggy nominal GDP, okay, kind of like real GDP, and a new overlay of $4 trillion in debt.
Well, I mean, longer term, I think that's what's happening with the dollar. I mean, I think there are fears about the fiscal path of the U.S. longer term, so it's driving a narrative both of longer term inflation and positive for gold and positive for break evens and all these things. But there's just a very important hump to get over first, and that's the disinflationary pressure of the high unemployment. And I would say also, without very high Fed purchases, you're likely to see a decent slowdown in bank credit and money supply growth over the next 12 to 18 months. And so if your argument is based on those things, your argument may fall apart.
John, who booked him? We don't do this much gloom on a Monday. James Sweeney, how are the market people at Credit Suisse reacting to your cautious view? The bond guys and the equity guys, they're different. How are each of them reacting to this scenario?
Well, I mean, a lot of the bond guys basically agree with it. I mean, on the equity side, our house view over in Zurich, our investment committee recently went from overweight global equities to neutral, and part of it is based on these fears as we get into the autumn. And I mean, neutral is not underweight, and risky assets are of course doing okay.
Yeah.
But looking forward, I think expected returns have definitely come down.
Hey Tom, this plays into the Golub trade as well, that you'll pay a premium for growth. Jonathan Golub, far more constructive on the growth names, big tech, than most people I speak to on Wall Street. Well, it has been for quite a while.
Yeah, and that's to the conversation we had earlier with Alicia Levine at BNY Mellon, who went the other way and said you've got to go away from growth right now. I mean, John, these are these huge tensions, all of them secondary to what we see in Washington over the next 48 hours.
Well, James, not just on the fiscal debate, let's talk about the Fed. They meet in 48 hours' time as well. Just sounds like you're positioning now, thinking about the next move. Governor Brainerd really stimulated this conversation in the last couple of weeks when she said we'll move from stabilization to accommodation. And everyone on Wall Street was like, well, what was the last few months about if that wasn't about accommodation? What does that transition look like in your mind?
Well, I think the last few months were about emergency measures responding to the cash flow crisis through the shutdowns and trying to ensure market functioning. And, if anything, they've over-insured market functioning. But I think going forward, again, it's where does the unemployment rate settle? What does the growth in inflation look like 3 or 6 months from now? And I think most of us think that activity is going to be running at a pretty low level, and so you're going to need more help from the Fed. So you may be pulling back some of these emergency measures, but in the short run, I think the Fed may signal that until unemployment and inflation are at exceptional levels, some kind of substantial stimulus is going to be in place. And I think in the background is yield curve control as the next big bazooka to be fired at a time when you're in severe market and growth stress. So hopefully that doesn't show up, but that's the big option.
James, aren't we in yield curve control right now? I mean, I'm looking at a 10-year of 0.58%. How do you control a number that low in America?
Well, I mean, the fact that the market is behaving as if it's already implemented serves the Fed's objectives. Like, that's a good thing. So what you don't want is the market to start to think they're never going to do this. And so yields, the curve starts to steepen, yields start to, move in a way that suggests, tightening of financial conditions. So at some point, they may need to formalize this thing. But at the moment, there's certainly no need. Risk assets are doing okay, and yields are doing exactly what we need them to do.
Hey, James, great to catch up with you. Send our best to the team at Credit Suisse, won't you? James Sweeney there, Credit Suisse chief economist. Tom, this Federal Reserve took a blowtorch to a credit market that was freezing, a monster blowtorch. The next move, I think we just have to pay far more attention to. Not drown in the snark, because there is a view that the last few months, come on, that was just about stabilization and not about accommodation. Put that to one side. The Fed is signaling something here. There's a transition in play. I don't know whether Wednesday's too early, whether you have to wait until maybe September to see what forward guidance looks like, whether they formalize this low for longer, low for a whole lot longer, and slowly drift towards yield curve control. Tom, the threat of it, though, to James's point, is the reason the yields to the upside are somewhat capped.
First thing, I have never heard James Sweeney that cautious, John. In all the years
I would
I've
agree
known
with you.
him, I've never, ever heard Dr. Sweeney that cautious. John, what's so important to me is you knew where we were in February and March, and we never imagined a July like this. Why do we think we're any different now? How do we imagine November right now? I can't.
Lifetime away. Equity futures this morning up 14 on the S&P 500. We advanced 0.4% on this Monday morning. Here's the price action. There's your euro through 117 at 117.48, up 0.8%. Yields lower, down by a basis point, 0.58%. And there's your record. Spot gold through 1900, 1933. Off the highs of the session, still lofty levels compared to where we started the year, up by 1.65% this Monday morning. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Today, Senate Majority Leader Mitch McConnell is expected to release a $1 trillion coronavirus relief package. That sets the stage for talks with House Democrats who passed their relief bill a couple of months ago. The Republican proposal would extend supplemental unemployment benefits, but at a lower level. It would also provide another round of $1,200 direct stimulus checks. White House economic advisor Larry Kudlow insists the U.S. economy is still set for a third-quarter recovery. Kudlow said on CNN that the virus surge in Sunbelt states will have a limited impact on the rebound. He's predicting a 20% growth rate in the second half of the year. Shares of Moderna are rising. The biotech firm's coronavirus vaccine enters its Stage 3 testing today. 30,000 people are involved, and the federal government just gave Moderna a second award, this time for $472 million. It's now received more than $950 million in developmental money. Spain and 2 British airlines are blasting Prime Minister Boris Johnson's virus quarantine. Over the weekend, the British government ordered a 2-week quarantine for travellers from Spain. That's the UK's top tourist destination. British Airways and EasyJet called it another blow to British vacationers. And Bitcoin rose above 10,000 for the first time in 6 weeks. Fans of the largest cryptocurrency have called it digital gold. It's in favour as concerns rise about the health of the world economy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
None of us are safe until all of us are safe. We need to have a global approach into handling and fighting COVID-19, a global pandemic. Part of this, of course, finding an effective vaccine.
The Senate majority has assembled a framework for CARES 2. The administration has requested additional time to review the fine details, but we will be laying down this proposal early next week. We have an agreement in principle on the shape of the package.
Senator Mitch McConnell there, the Senate Majority Leader Tom Keene. We expect the big reveal to happen at 4:30 Eastern Time down in Washington, D.C. Lisa Brambett's back with us tomorrow. I'm Jonathan Ferro, together with Tom Keene. This is Bloomberg Surveillance. Tom, I'll step away in just a moment to catch up with Jared Woodard, the head of Bank of America's Research Investment Committee, on the big trades playing out in this market right now. Gold, euro breaking out, dollar breaking down.
Well, not only that, but with Jared Woodard looking at what people are actually doing with their money, particularly on the buy side. That will be most interesting. Right now, off of what we heard from Senator McConnell and the mystery of what we'll see today from disarray in the Republican Party is the reality of what it means for the funding of our transportation. That can be DFW in Dallas. That can be the airlines out west, the railroads, coast to coast, Amtrak even. Or it can be the MTA, the chairman and CEO in Washington. On the FOIA desperation meter, how badly do you need federal help after the rider shortfall you're seeing?
On the desperation index, we're facing a fiscal tsunami, a once-in-a-100-year fiscal tsunami, which has left our infrastructure intact but demolished 40% of our revenues. We exhausted on Friday the last of the CARES dollars that we got several months ago. That was about $3.9 billion of funding. We need an additional 3.9, and these are shocking numbers, to get us through the remainder of the year. Our revenue sources come from our customers, fares and tolls. Those are down precipitously, and the remaining half of our revenues comes from a dedicated package of taxes and subsidies, which are economically sensitive, and those too have fallen off a cliff, Tom.
Do you get a feeling Washington and different flavors, including the gentleman residing above the Gucci store on Fifth Avenue, do you get the feeling they're saying New York dropped dead?
I hope not. I think we'll find that out in the weeks to come. Clearly, states and cities around the country, including New York City and New York State, are in desperate need of funding. I'm here to talk about the MTA today, and the MTA is in desperate need of funding. The MTA is not only just a mass transit agency, it's frankly the circulatory system of the New York City regional economy, and not funding the MTA will stunt and thwart economic recovery and job creation all over New York.
Well, give us a sense of that scope and scale. I mean, we understand the subway system, the buses. I give you major credit for showing the decline in ridership numbers right up front on your website. But give our viewers and listeners worldwide a sense of the geographic reach of the MTA. It's not the 5 boroughs, is it?
No, it's beyond. Subways, buses in New York City, 5 boroughs, Long Island Railroad goes out Nassau and Suffolk County. Metro North covers Westchester and North, as well as part of Connecticut. And we've got a small operation that New Jersey Transit runs for us west of Hudson. In a typical day pre-pandemic, we'll carry well over 8 million passengers. Pre-pandemic subway ridership, average weekday, 5.5 million customers. Right now, 1.2 million. That's up substantially from the depths of the pandemic, but a fraction of the numbers that we would carry on all of those agencies.
And my anecdotal on this, folks, is real simple. I was thunderstruck how empty New York City was this weekend, like I've honestly never seen it in my time at Bloomberg. And Pat Foy, you're living with this, with the empty office buildings of Midtown, and there's all these other stories as well. If you get that aid, what do you do with it? Or do you have to begin thinking about firing thousands of people?
Well, Tom, here's what we're going to do. I'm cautiously optimistic that we're going to get the funding because, frankly, it's in the interest of the nation to fund the MTA to help bolster New York City's regional economic recovery. That's in the national interest. The pandemic is an international and national challenge, and it requires a national solution. So I'm cautiously optimistic that Washington is going to do the right thing. But without funding for the rest of the year, that's what we're talking about, to get us through 2020, the decline in revenues has been that precipitous. We will have to consider things like wage freezes, like service reductions, like headcount reduction, delaying or deferring the capital plan. We have a historic $51.5 billion capital plan that was approved a year ago. We've put that on pause. None of us wants to replay the movie from the 70s and 80s when the MTA didn't invest in subways and buses and service declined.
Pat Foy, we've got some breaking news here, so I'm going to have to let you go, but we'll monitor this carefully. And, of course, the MTA folks with a huge reach in New York. We welcome Bloomberg 1130, particularly listening to this morning. Mr. Foy is chairman and CEO of the MTA. There's a number of breaking stories right now. No surprise here in that Google will keep their employees home until summer. That from Dow Jones. And we're seeing this in different shades, I would say, day to day, where some people are doing part, some are doing all. But the way this headline reads, it reads all employees home until summer. Far more importantly and timely for Washington is, once again, a member of public service has the virus. You know Robert O'Brien, of course, our national security advisor. Call him the gentleman that replaced Mr. Bolton. Would be one way to link into this. But Mr. O'Brien announces that he has the coronavirus, and no doubt that'll be a quarantine. But just as importantly, you wonder how that will fold into who has been with him over the last number of days. I want to set up the markets here as we go to John Farrow in the open, and I'm thrilled that Paul Sweeney will be with me on Bloomberg Radio. I believe Doug Cass scheduled to be with us, which will be more than timely. Futures up 13. They were up 17 earlier. 32.16 on SPX, Dow Jones 26.390, and the VIX has really been quiescent. The VIX 26.36 really hasn't done much. To me, the massive story is in the bond market. It's not as grim as it was an hour and a half ago, but nevertheless, compressed yields this morning with the 0.58 on the 10-year yield. And I would note the inflation-adjusted yield, the real yield, extraordinary, where we've seen that negative 0.92 on the real yield. Oil's done nothing, really not part of the story this morning. And then gold $58 the ounce. It's down $10 from where it was 2 hours ago. But nevertheless, gold up $33 per ounce. Again, an extraordinary statement there. Axel Merck out on Twitter with a great chart overlaying the real yield of the 10-year in gold. And it's just amazing, the lockstep feel there, as we've heard from so many people as well. We've got a busy day for Bloomberg, lots on politics. Look for David Weston in Balance of Power. Vivek Sankaran of Albertsons will come by for perspective on a grocery industry adapting to this pandemic. Please stay with us through the morning. This is Bloomberg.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York City for our viewers worldwide, good morning, good morning. The countdown to the open starts right now. We begin with the big issue. Republicans struggling to agree with each other, now looking to find agreement with Democrats. Negotiations beginning in Washington with $2 trillion separating both plans and disagreement over expiring enhanced unemployment benefits. Treasury Secretary Stephen Mnuchin stressing the importance of the entire package.
All these different pieces have to work together, where it's the Paycheck Protection Program, or whether it's the direct payments we send, or whether it's the money to schools. All this works together. So UI is just a component of the overall economic package, which everybody wants the same thing, which is let's get kids back to school where it's safe, and let's get workers back to their jobs.
House Speaker Nancy Pelosi making it clear where Democrats are focusing, with a major divide remaining, saying, quote, why don't we just keep it simple? Unemployment benefits and the enhancement, which is so essential right now, and that's really where we are starting. Joining me now is Kevin Cirilli, Bloomberg Chief Washington correspondent. Kevin, there's got to be some urgency down in Washington. At 4:30 Eastern, you'll be presiding over all of this down in Washington. They'll unveil their agreement, except it's not clear they agree on anything on the Republican side right now.
It is not clear that they agree on everything right now, and we've got new details precisely over what is being discussed as Senate Majority Leader Mitch McConnell set to unveil the specifics of the bill sometime later today. But they're talking about only 70% of the unemployment benefit of the worker's wage. If we pull up those details, unemployment benefits at 70% of the worker's wage. Democrats are saying immediately that's not that's a non-starter. A new round of $1,200 direct payments and funneling money to schools for reopening, not just public schools, but also private and charter schools as well. Plus, funding for expanded virus testing. Jonathan, the big debate here is whether or not 70% of the unemployment benefits is going to be enough not to just get some Democrats on board, but some centrist Republicans on board who are being hit by their constituents, for many of whom haven't received adequate or any payment since this pandemic began.
Well, Kevin, it's not just about size, it's about execution. You and I have been talking about this through the morning. In the UK, we do something similar, but you can execute it more easily than the United States, which has to roll this out across multiple state offices. Can they even execute something like this in the near term, even if they agree on it?
If we have to go by the CARES Act implementation, the answer from the small business community would be that the relief did not come fast enough. In fact, several lawmakers on Capitol Hill, both on the Republican and the Democratic parties, are trying to figure out how to micro-target businesses. Senator John Thune, one of the top Republicans in the Senate, as well as Senator Chris Coons, a Democrat from Delaware, both prescribing different policy prescriptions in order to say that small and medium-sized companies would get access to capital that, quite honestly, they just were not able to get in the previous rounds of stimulus. Two final quick points I would make. One, that there's likely going to be another round of stimulus come the fall. The president sees this, I'm told, as not his last economic pitch ahead of the election. And two, that millions of Americans receive no payments in underserved communities, quite frankly, because they're not registered in some of the systems that the government can provide funding to.
Kevin, Senator Lindsey Graham has said half of Republicans are going to say no to this. How do you expect the Democrats to respond after the big reveal at 4:30 Eastern?
The Democrats feel that they have political capital right now. They feel that if they look at the polls, there's just an NBC News Marist poll that came out within the last couple of hours that shows the presumptive Democratic nominee Joe Biden leading there by 7 percentage points. They feel that they have the political capital to stick together, to press for additional funds. And that's why you're seeing such a different money marker of $3+ trillion coming from the left. But the Republicans that are taking issue with this are looking past November 3rd and into the midterms of 2022 and 2024 and thinking that history would repeat itself with fiscal conservatives and a rebirth potentially of the Tea Party.
Hey, Kevin, great to catch up with you, sir. Kevin Cirilli there down in Washington, D.C. Compass Point's Isaac Boltanski weighing in on the negotiations, saying the following. The initial Senate GOP offer will suggest that there is a cavernous divide between the negotiators, and there will be a moment in the coming week where the entire effort appears dead. Shortly thereafter, however, we believe the timing pressure will catalyze a deal. Isaac joins us on the phone for more. Isaac, let's discuss this a little bit further. At 4:30 Eastern, Republicans will say this is our agreement, except it's not clear there is an agreement with Republicans. Is there one, Isaac?
Thus far, no. And this is just when you think Washington can't disappoint you any more than it has in the past. It wasted an entire week on intra-party GOP squabbling. And I'm still not sure that that week got us to a place where there's Republican agreement. And so from the investment community, I think the takeaway is pretty straightforward. If Republicans aren't going to carry the vote on this, it means Democrats will have to in both chambers. And if that's true, the price tag is going up. And I think directionally, that should be our takeaway for the morning.
Well, Isaac, let's talk about this then. How do you think Democrats will respond to this in the coming hours after that big reveal?
They're going to outright reject this opening offer. I think that there's things in this Republican proposal that we're going to get later today that Democrats are squarely behind. For example, the recovery rebates, those individual and family stimulus payments. That's something where there is agreement on both parties. But there's some big ticket items that are going to be left out or not nearly the size that Democrats want. And here I really think that we've got to focus on state and local funding, which at the moment doesn't appear as though it will be addressed to the same degree as Democrats want, and the unemployment insurance. To me, the 70% wage replacement threshold is an interesting construct and one that the UK has done well because of their system. But we have so woefully underfunded our state unemployment agencies that I just don't see how you can do anything other than eventually agree on a flat fee as a supplementary payment for unemployment.
Isaac, have the Democrats shown where they'd like to bring that flat fee down, other than just say it needs to be $600, you need to extend it?
Thus far, they have held the party line hard at $600. But as we know, now that we're done with the intra-party squabbling phase among Republicans, now we get to go back to our regularly scheduled squabbling between Democrats and Republicans.
Yeah.
That $600 number will go lower. I just don't think it's going to go meaningfully lower. I'm telling my clients somewhere between $200 to $400, depending upon how this week goes. And within that range, I'm on the higher end if Democrats are now driving the bus.
Isaac, it's 99 days until the election. What do you make of the strategy of this administration? Kevin Cerulli was talking about this maybe not being the last bill, but for most people, they think this is going to be the last big bill, the last big policy effort down in Washington ahead of November. What do you make of the strategy out of the White House?
So I think that this will be the last big ticket coronavirus bill of the year, but there are going to be other efforts. And so I do know that there will be a spending bill at the end of September. We need to address federal spending again. That can prove to be a legislative vehicle. And I think that in the lame duck, we're going to have to tackle some of the problems that we're tackling in this bill, such as expiring unemployment insurance and other measures. My big message to clients is deficit hawks are an endangered species on Capitol Hill, and I think that DC is going to continue spending. There's a phase 4 that's going to get done over the next 2 weeks or so.
Yeah.
And yes, we will absolutely be speaking about a phase 5 in the fall or in the lame duck session.
Isaac, brilliant to catch up with you, as always. Isaac Boltanski there of Compass Point on the policy effort. We've said repeatedly on this program, if the debate and the negotiations get bogged down in size, something can be done pretty quickly. If it's about concepts, it's much tougher. And the debate right now is around concepts. How best to replace those enhanced unemployment benefits. That's the debate down in Washington. Huge week ahead for big tech. We have hearings later in the week, then some big earnings news as well at the back end of the week. We have a little bit of a rescheduling, though. Let's cross over to Abigail Doolittle for some breaking news. Hey, Abigail.
Hi there, John. Well, indeed, we do have a little bit of a rescheduling, or possibly a big one. We have Facebook saying that they are now going to release their second quarter results on Thursday, July 30th, as opposed to Wednesday, July 29th. Very unusual. However, they are saying it's a scheduling conflict, and that scheduling conflict has to do with the fact that CEO Mark Zuckerberg is now going to be providing a congressional testimony on July 29th. Now, earlier the stock had been up 1% initially when the news crossed, down a little bit, now up just slightly. Then we also have one other piece of breaking news, and that is the fact that CEO of Walgreens, Stefano Pacino, has decided to step down as CEO. He will assume the role of the executive chairman, and the board of directors will begin to search for a new CEO. The stock earlier had been slightly higher. Now it's just down a little bit. John? John.
Abigail, thank you. Coming up on this program, Jared Woodard, Bank of America, B of A Securities Research Investment Committee head. That'll be coming up next in your equity market right now, 20 minutes away from the opening bell. Equity futures drifting higher this Monday morning. The euro breaking out, gold at a record from New York. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it'll take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
The U.S. no longer dominates Europe in terms of economic outlook, and that is a major change. Europe is getting its act together. The U.S., unfortunately, is allowing health issues to contaminate the economy. So it is getting more complicated in terms of what it means for the dollar. I, for one, as you know, no longer believe that the U.S. dominates Europe in terms of valuation.
Bloomberg opinion columnist Mohamed Al-Arian making the case for Europe, but new outbreaks of the coronavirus in Spain fueling concern across the continent, even prompting the UK to impose a quarantine on travellers returning from the country. Michael McKee, Bloomberg International economics and policy correspondent, joins us now. Mike, the data looking decent in Europe again this morning with German business confidence breaking out, but the coronavirus story really starting to shake some conviction a little bit as we come into a new week.
Absolutely, John. Well, Europe locked down sooner, Europe locked down stronger, virus transmission rates were much lower, and it looks like economies on the continent are coming back more quickly than the U.S. You mentioned the IFO numbers this morning, expectations up to the highest since 2018. French unemployment at the lowest since records began being kept in 1996. Those PMIs last week showing expansion in manufacturing and in services, best performance since 2018 as well. Bank lending really strong. In the U.S., however, not so good. The new wave of coronavirus spreading across the country is starting to stifle the economy again. We don't have deep monthly data, but the high-frequency numbers we're looking at don't look good. Of course, jobless claims last week starting to rise again. Then you look at consumer sentiment. It deteriorated last week. Retail sales slowing, the weekly indicators suggesting, and most ominously, perhaps at the height of the summer driving season, we're starting to see gasoline demand fall off. So to this point, you could argue a clear win for Europe. But while the headline readings show the region's economy is rebounding, there are warning signs. There is uncertainty in the case counts in Europe, in part because there are signs the case counts might be rising. You mentioned Spain and the UK lockdown, the 14-day quarantine that has to be applied on travelers from Spain. Germany's public health authority says they're facing a new outbreak in Bavaria. They don't know how bad it's going to be. They've taken some strong measures to try to control it. The German PMI report on Friday did show a drop in factory employment. So even though we're seeing some expansion there, it may be that the U.S. slowdown is hurting export-dependent economies like Germany in Europe. So some warning signs there, even though at this point the Europeans are ahead of the U.S., it's still, I guess, the bottom line message, the virus controls all.
Mike, what do you make of the FX action off the back of a lot of this? The euro's starting to break out, the dollar's starting to break down. What's your take on things at the moment?
Well, it's always hard to judge the Forex markets, but in this case, it seems that the simplest answers are the best, and that is that Europe has put together a better performance. They've got this stimulus bill coming. Doesn't really matter that it's not going to put a lot of money into the economy yet. It is there and shows some unity in Europe, while the U.S. is incredibly divided politically and doing a bad job on pandemic control. So if you're going to look for an economy that's going to do better right now, you're looking at Europe.
Mike, great to catch up with you, sir. Michael McKeown, a big week ahead. We'll catch up with Mike a little bit later ahead of that Fed decision this week. Bank of America saying that when it comes to stocks, the U.S. still presents the best opportunity. Ryan, again, a note, U.S. equities are not cheap, but we are bullish because, one, there is no alternative, and two, stocks are more defensive than they seem. Tech and e-commerce are more like utilities than discretionary. Bank of America's Jared Woodard joins us right now. Jared, great to catch up with you, sir. Why still so constructive on the U.S.?
Well, look, investors reward good governance, and that's what you've seen this year, to the surprise of many of us. You've seen big stimulus measures from the U.S., now out of Europe. Japan has come through, even China has come through, and that's been the big driver of returns. I think it dominates the action on economic data as well as market data more than any other single factor this year. And to the extent that the U.S. is able to continue, hopefully this week, maybe next week, with another round of stimulus to support households and to support revenues for businesses, then that's going to be the key catalyst to keep investors in the game and to keep investors allocating to equities in a world of incredibly low bond yields.
Jared, do you think that the relative European optimism of the last few weeks is misplaced?
I don't think it's misplaced. It's been a great sea change, I think, really, in terms of the policy environment. Obviously, the recovery package coming through is a huge boost. You're seeing that in the FX, as you all were just discussing. I think it's important to watch what happens. Two things we want to look for in the future that would give investors a lot of confidence to increase their allocations from incredibly low levels today. Number one would be if the European Central Bank and regulators give permission for banks in Europe to resume paying dividends. And second, if we do see a rebound, when we see a rebound in the European economy, if we see a strong inflation print, let's say something above 1%, when the economy is much more stable footing, if regulators and the European Central Bank can look at in the face of a little bit of inflation and not make any hawkish noises, I think that would persuade investors that this really is a new kind of a new policy environment in Europe.
Jared, you don't think we're there yet then? Because I do wonder whether this can feed on itself. You start to see that dollar weakness, you start to see that euro strength, you start to see the euro outperformance. People start allocating to it and it kind of feeds on itself. Could you see that emerging?
Absolutely. I mean, the weaker dollar is, I think, unquestionably good news. Remember, in March, on one trade-weighted measure, the U.S. dollar was near one of the strongest points in history. I mean, it's been incredibly tight, incredibly strong dollar, and so this decline lately is simply a sign of improvement around the world, of risk appetites looking abroad for the first time in a long time, and so I think this is an unquestioned positive. It can have some effects that can become self-reinforcing, but obviously it's going to be driven ultimately by data and by strong policy, and that's what you've had on the news front the past few weeks. So I do think these flows to Europe at this moment are really justified.
Jared, I was just looking at what you are constructive on right now: equities, corporate credit, gold. Gold's in there too, and this is interesting, where you can be constructive on risk assets but simultaneously be long gold. Why is that the case, Jared?
Well, investors do want to hedge. There's a lot of uncertainty. They want something that's going to reduce their overall portfolio correlation. And unfortunately, our argument has been really since last year that the end of 60-40 means the end of Treasury bonds as a place to go for that kind of hedge. Our view is that the long bond is dead money. And so if you need something that's going to be differently correlated from equities, gold's the best candidate here. From a real rates point of view, central bank policy, the outlook for inflation, all favor gold. And if policy stimulus does fail, if talks in Congress, for example, were to take a bad turn, then there's still some meaningful economic risk out there, and gold looks like the best place to go when you need that kind of hedge.
Okay, we won't let that slip under the radar. That's huge. The end of the 60-40 thesis. You and I have talked about it a few times, but you still think it's the case. Walk me through what replaces the 40, Jared. What do you want to be doing? What are you telling your clients, and how receptive are they to this idea?
Well, it's gone from, I think, a pretty contrarian call when we started this theme last year to now almost a consensus a little bit. I mean, certainly something that's come up in the broader conversation. I think that the case that long-term Treasury bonds are going to function well as a portfolio hedge has never been weaker. We looked at the last 4 recessions. On average, I mean, Treasuries really worked as a hedge in the past, precisely because yields fell around 150 basis points on the last 4 recessions on average. Today, at 60 basis points on a 10-year yield, there's simply not that much room to move. And so when we look for alternatives, we think, number one, if you need a hedge, if you need some place to go, cash remains an option, doesn't pay you, neither should a hedge. If you are more moderate to constructive on the cycle and you do need some yield, we would note 2 things. Number one, there's good opportunities in credit. The Fed has your back. You can take prudent risk and not fight the Fed, and we profile some different parts within fixed income that are still attractive, aside from Treasuries. But I think number 2, it's worth noting that more than 70% of the S&P 500 pays dividend yields greater than Treasuries today, and that's the highest record level in history on that comparison. So for investors looking for an income stream, there's better places to go than taking that rates risk. And for investors looking for a portfolio hedge, cash and gold look much more attractive if you really are uncertain about the future of the economy.
To be clear here then, this isn't about directional reverse correlation breaking down, Jared. Do you think this is just about the scope to rally? We're at 60 basis points. You haven't got much left.
Exactly. It's not going to work well as a hedge if by some strange measure the Fed decided not to pursue the yield curve control in the near future. If they decided to become less interventionist, then there's lots of scope for bond yields to start to hurt. And that's happened before in history. The taper tantrum not that long ago is probably the best example from recent history. But we know that even if yields don't move significantly higher, in the case of an economic breakdown, there's just not much lower they can go either. And so from a hedging and asset allocation point of view, we think that this end of 60-40 thesis actually looks more attractive now than it ever has before.
Does IG fall into that bucket? Does it get upgraded, so to speak, as some kind of buffer in the portfolio, Jared?
Absolutely. I think the big takeaway from a fixed income point of view is if you look at other fixed income sectors to increase allocations, that includes corporate bonds. We like convertibles. We like even some emerging market debt, which is going to be a big winner on the back of this dollar weakness. But if you look across the credit spectrum, we think you can find yields there that are maybe a little bit less correlated to equities or a little bit less sensitive that can still give you some income. And at this point in the cycle, we're pretty confident that the lows are in for the market, which makes this a moment in which it's wiser to allocate to something that will at least pay you a meaningful yield rather than tie up all of that capital in something like the Treasury market.
Hey, Jared, thank you. Great to catch up with you, sir. My best to the team. Jared Woodard there of Bank of America. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls. And later, we're previewing the big week for big tech. Wedbush Managing Director Dan Ives joining the program from New York City this morning. Good morning. Equity futures up around about 13. We advanced 0.4%. For our audience worldwide, you're watching Bloomberg TV.
Nissan Ariya is the one that represents for the Nissan new chapter. I would say that the Nissan has a great experience because we have 10 years of the history through the Nissan Leaf. We have learned a lot of the voice from the customer.
Equity futures pushing higher, up 13 on the S&P 500. A beautiful Monday morning in New York City. We're up 0.4%. That's the price action. Let's get to the morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Credit Suisse downgrading Archer Daniels to underperform with a $39 price target. The analyst expecting weakening demand and changing dynamics in the grain business to start creating major headwinds. That stock is down by almost 2%. Your second call from Raymond James upgrading American Airlines to market perform from underperform with no price target. The analyst signing a more balanced near-term risk-reward following some big declines this year. That stock advances 0.8%. And your third and final call this morning, it comes from Telsey Advisory, raising its Amazon price target to $3,600 ahead of earnings this Thursday. The analyst expecting an accelerated shift into online retail as a result of the coronavirus pandemic. We are up there by 1.82%. That's three of the big calls this morning. Up next, more on Big Tech this week with Dan Ives of Wedbush. From New York City, the opening bow just around the corner. Futures higher, gold breaking out, the dollar breaking down. Much more still to come on Bloomberg TV.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Tech stocks flying out of the blocks this Monday morning. Equity futures on the Nasdaq up by 86. We're up 0.8%. S&P 500 futures up 12, up 0.4%. The equity market drifting higher. Switch up the board in the bond market. Treasuries, big week for them. Had a big expectations ahead of the Fed. Dovish expectations, looking for the next move. Governor Brainerd say we move from stabilization to accommodation. What does that mean? Find out Wednesday. Yields down a single basis point to 0.58%. Euro dollar impatient. Getting impatient at 116 and just shifting car towards 117 and 117.35. And in the gold market, spot gold just 5 days between 1800 and 1900, 1958, up by 1.7%. We have record highs in the gold market. That's the cross-asset story. Let's get you some movers at the market desk. Here is Bloomberg's Abigail Doolittle.
John, before turning to the gold miners, which are trading up in sympathy with gold, let's take a look at two leaders and then two laggards. Starting off with the leader, Moderna shares are popping higher once again. This on the news that they've received more funding from the U.S. Specifically, they have received $372 million from the U.S. agency BARDA. This brings their total to nearly $1 billion. And they're also kicking off a second stage trial along with a phase 3 trial here in the U.S. around the coronavirus. We also have Taiwan Semiconductor, the ADR, popping sharply higher. This, of course, in the news last week from Intel, their delay of a next generation chip. There's some idea that perhaps Taiwan Semiconductor may get the contract. Apple's their #1 client. It'll be interesting to see what they report later this week. To the laggards, though, John, Hasbro, they put up a bad quarter. They missed sales estimates by 14%. They put up 2 cents on the bottom line versus the 20-cent estimate. They still expect holiday sales to be strong. The shutdown was helped, if you can believe it, by Nerf and Play-Doh. And then Lemonade, the insurance company, initiated Goldman. Not initiated, I should say. This company, of course, went public about a month ago. So we have the street research out. So Goldman's out with a sell rating. Other big banks with equal weights. The stock is up 170% over the last roughly month. So valuation. And then there's those gold miners simply soaring. Investors, traders want in on anything to do with gold and silver, John.
Abigail, thank you. Thank you very much. 2 minutes into the session, massive churn beneath the surface of this equity market. We advanced on the S&P by just 0.05%. Top of the pile, big tech. We're up by 0.5% for IT. Bottom of the pile, we have got financials down by 0.8%. A huge week ahead for tech companies, particularly the big ones. Ahead of that, Katie Koch at Goldman Sachs Asset Management weighing in on the recent underperformance.
You have these tech companies that had very elevated expectations, and they're actually coming in a little light, and that's causing many of them to sell off. And then on the other side, you're actually having some of these cyclical companies, industrials, beating some of those low expectations and getting a lift from the market. And that's caused the growth value dynamic to really narrow by about 7 or 8% over the last couple of weeks.
Katie Koch there of Goldman Sachs Asset Management. Bloomberg's Katie Lyons joins us now. Katie, big week ahead. Tech hearings, then big tech earnings.
Yeah, very big week for big tech, John, especially so considering we're coming off 2 consecutive weekly losses for the tech sector in the first back-to-back down days on the NASDAQ 100 since all the way back in May. Rebounding this morning, yes, but still a lot of risk ahead. And I really want to talk about the fundamentals to set the stage here because we have to consider the premiums at which these tech stocks are trading. If you look at the forward PE ratio of the S&P Information Technology Index, that's trading around 24.5. That is healthily above the 5-year average of around 17.5. It's been above that average, granted, for really the past 14 months, but that gap is near the widest it has been. And the question is whether these frothy valuations are warranted, because on a relative basis, yes, tech earnings aren't actually supposed to be that bad. Then the second quarter expected to drop just about 6.3% relative to the 43% decline for the broader market. But still, that sets a very high bar, making it easy to come up short. And this is true for those largest cap stocks in particular. We saw that play out with Microsoft results last week, and then we'll get the remainder of the heavyweight reports coming up this Thursday. Facebook, Apple, Amazon, and Alphabet all reporting on the same day, and that would be risk enough, John, but then you have to layer on top of that the reason why Facebook pushed its results back a day, and that is the risk coming out of Washington, D.C. On Wednesday, all 4 CEOs of these companies will be attending a virtual congressional hearing on antitrust that includes Jeff Bezos, who has never testified before Congress before. I looked at the antitrust subcommittee calendar, John, and the actual name of this hearing is Online Platforms and Market Power, examining the dominance of Amazon, Alphabet, Facebook, and Apple, and if that doesn't scream regulatory threat, I don't really know what will. This House probe is seen as likely to end with recommendations to change competition laws, and that could threaten that dominance of these high-flying names, John.
What a week coming up for these tech names. Kelly, thank you. Kelly Lyons for the market desk. Dan Ives of Wedbush weighing in on the recent volatility, writing, quote, "We view last week's sell-off as a speed bump that will be short-lived, expecting strength from the FANG earnings, but the antitrust storm clouds appear to be building in the beltway against big tech, looking ahead into the rest of 2020. Dan Ives joins us now. So, Dan, walk me through this. Is this an opportunity to put something on the highlight reel ahead of the elections through to November for some of these politicians, or is it something for Wall Street?
Yeah, I think that's the big question. Is it a grandstanding event or really more of a Fort Sumter moment in terms of antitrust? And I think that's something we'll get a better sense for this week. I do think the momentum is building against antitrust, against these giants. You're seeing it stronger and stronger in this COVID environment. Right now, the street continues to view it more as background risk with fines likely, but I do believe this is a drum roll into the fall.
Dan, you've picked up on something important, though. Fines don't really matter to Wall Street. What matters to Wall Street are structural changes to the business model, policy efforts that actually transform these companies. Do you see it being more of the former and not the latter?
For now, I see it more of fines, but I do believe you're starting to see the momentum continue, and I think against antitrust. So I think what that's going to do is going to slow down M&A, and I think if you start to get a Democrat-controlled Senate with a Biden White House, that's something in the investors start to really factor in. This is more of a risk. Right now in these valuations, that's not being factored, but obviously a massive week for tech between this as well as the rest of FANG earnings.
Dan, traditionally, you know how these conversations go. We talk about who's vulnerable. We'll say Facebook, we'll say Amazon, we'll say Google for obvious reasons, and we say Apple's done a great job of staying out of this. Why is Apple getting caught up in this? What's the one big worry for you?
I think right now it's about the 30% fee because you're starting to see that App Store focus, not just here, but in the EU as well. That's a big focus, when you go looking forward for Apple, as that continues to be a core crown jewel in its ecosystem for Cook and Cupertino.
So walk me through the balance of risks around that story for this company.
A balance of risk going forward is that you start to see more pressure on the fees. That ultimately does put something, at least from a street perspective, that's more of a risk. I don't believe it is, but I think if you start to see more pressure on that, we believe the services business is worth $600 to $650 billion. So I think right now that's starting to be a little more of a focus of the street on both sides of the pond.
So on Wednesday, we listened to all the big CEOs from these companies. We fast forward to Thursday, Dan, and we get the earnings from these four big companies as well. What is the focus for you in earnings season from the big four this Thursday?
Yeah, and I think you saw a little with Microsoft and Tesla with that momentum coming off in terms of good news baked in. I think you'll see the opposite going into this week. I think you're starting to see the secular trends that are massive out there for e-commerce as well as cloud and Amazon. I continue to think engagement on the social media company as well. And for Apple, it's the services business. And really what's going to be now the look to iPhone 12 is what I believe is a super cycle. Street's looking past a lot of these quarters to really on the other side of the dark valley. And I think right now, momentum's there for FANG names. Still think FANG names go another 20, 30% higher in the next 9 to 12 months.
Dan Ives, a big call that you've been right on for the last several years. Dan Ives there of Wedbush on Big Tech. Let's get back to the market desk, shall we, on the price action this morning. Equities higher on the S&P by 0.1%. Beneath the surface, though, all about Big Tech. The Nasdaq up by 0.9%. At the market desk, Abigail Tillittle.
John, let's take a look at a few other movers here around the open, starting off with the shares of Under Armour. They are down, maybe not down as much as you would expect, although on the year down about 50%. So perhaps already absorbing some of the news. And that, of course, is the fact that CEO Kevin Plank and CFO David Bergman have been named in an SEC probe. Not necessarily a surprise. Somewhat of an ongoing investigation has to do with accounting on forward sales back in 2015 and 2016. And the SEC has made a preliminary decision to recommend enforcement action. On the other side of retail, Tapestry popping higher. This is they've been raised to a buy at Goldman Sachs. The firm saying that there's a potential for margin improvement. They're crediting their new marketing campaign, plus less dependency on department stores, which, of course, in this day of the pandemic, very important. And then finally, Nikola, the electric truck company, once again popping higher. This on the news that the Chinese SUV maker Li Auto is seeking a roughly $950 million IPO here in the U.S. The high valuation offsets worries over over a rising electric vehicle competition, and China, of course, is the largest global market for EV. The stock of Nikola, as you know, John, up 208%, getting an interesting sympathy tailwind this morning.
Abigail, thank you. Thank you very much. 9 minutes into the session, equities drifting higher. The Nasdaq back on top. Up next, looking ahead to the Fed decision later this week with Vishy Tirupattur, Morgan Stanley head of U.S. fixed income research. That's coming up next right here on Bloomberg TV.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's 12 minutes into the session. What an interesting morning already. The dollar breaking down, the euro breaking out, euro dollar through 117, gold at a record, and big tech back on top. The Nasdaq outperforms on the day. The S&P 500 up 0.25%. The Nasdaq up by 1.07%, ahead of a big week for tech, including a Fed decision later this week, this coming Wednesday. HSBC Steve Major saying rates could be lower for a whole lot longer.
Decade of denial, that's looking backwards. We can refer to 20 years at zero in Japan. Let's just imagine that it's more like 10 years than 1 or 2 years. Now, it's a big call to make because things change. Who knows what kind of government we'll have in 5 years' time? Who knows whether central banks will be as independent today as they are in 5 years' time? But I imagine we should be talking in terms of decades, not years.
Steve Major of HSBC there. A fascinating conversation. For the full context, try and listen to the whole thing because it's really, really interesting ahead of the Fed decision this coming Wednesday. Bloomberg's Michael McKee joins us now, our international economics and policy correspondent. Mike, great to catch up with you, sir. The Fed in focus this Wednesday. There's something that Governor Brainerd said, Mike, that's stuck with everyone. The move from stabilization to accommodation. What does that look like, that shift, in the coming months?
John, it's likely to be semantics rather than any kind of policy change. Nobody's going to go out 10 years at this point. Fed's not going to move rates on Wednesday. That's pretty much baked in, but with rates at zero, there's almost nowhere for them to go since they've ruled out the idea of negative rates. But they can change the formulation. We might get subtle messages to the markets about how long they'll keep rates low because they feel they want to stress the idea of accommodation. And that might mean instead of saying we're going to keep rates rates low till 2022, which they're doing right now, they'll get rid of the time factor and put in a state dependency. In other words, we'll keep rates low until inflation is over 2% for a while, or we'll keep rates low until unemployment gets to a certain level. They might also change the way they talk about QE. Up to this point, the bond buying they've been doing has been based on the idea of making sure the markets are functioning. They can change that to do the same bond buying, but say we're doing it to stimulate the economy, because that's really all they can do is raise and lower interest rates to do that. So we might see something along those lines this week. Most analysts think we won't see it until September. If we do get anything, it would either be in the statement or perhaps Jay Powell will talk about it in his news conference, because there's no new economic projections and there's no dot plot at this meeting. The one question is, if Jay Powell does talk about it, can he be dovish enough to satisfy the markets? Probably, given that the economic data are at this point deteriorating, so it's not likely we're going to see market rates start to move up.
We are all looking forward to the Michael McKee question in the news conference this coming Wednesday. Save it for Wednesday and give us a little bit of a tease this coming Wednesday. Mike, thank you. Thank you very much. The team at Morgan Stanley running the following. We expect the committee to continue to deliberate over the conclusions drawn from the framework review and answer lingering questions about how changes to inflation should be specified and implemented. We expect these changes in September. Vishy Tirupatur of Morgan Stanley joins us now. Vishy, is Wednesday just too early for you then?
Good morning, John. I think Wednesday is probably to set the stage for a more clear discussion and follow-up in September. I think this is they don't have to do anything at this point, and that we think they will need time to prep the market for a more clear-cut forward guidance based, which we think will be more based on inflation and not unemployment levels, and going forward. And I think this could be, I think the press conference could be one place we could get some more detail on this. Remember, there's one more opportunity. There is the virtual Jackson Hole conference end of August. That's another place where they could put out some more trial balloons before firming up in September. The one thing I do want to the question you just asked about about Governor Brainer's description in her last speech, I think it's one thing that's potentially they could open the door for is by suggesting going beyond sustained smooth market functioning to accommodation by increasing the duration of the asset purchases. That's a potential that is there. That so that increasing the duration actually would mean a longer duration asset purchases, longer term interest rates that are already quite low, but ensuring that they stay low.
So Vishy, this is important. I've asked this question many times over the last several weeks. Let me ask it of you. If I position for a steeper yield curve, am I going to be fighting the Fed in the not too distant future then?
That is definitely a possibility. In fact, our interest rate strategist Matt Hornback, we took off the steepener call, steepener trade recommendation, and we'll see what the messaging after the FOMC meeting this week on Wednesday and the press conference, and what we take away from that. But at the moment, we don't feel it compelling to put the trade on.
Well, Vishy, what people have been doing, they haven't been pushing this view through nominal yields. They've been pushing this through inflation expectations, the belief that the Fed stays super easy and inflation expectations start to pick up. Vishy, do you expect that? Because as far as I can see, just from a basic economic standpoint, the disinflationary forces going into year end are going to be really powerful. We'll be below capacity for an extended period of time. Vishy, why does it make sense to play for higher inflation expectations?
I think higher inflation expectations is something that the policymakers have been shooting for to achieve in a long time, and they really have not been able to get there. So with the expansion of the fiscal deficit, there is a room for inflation, not in the near term, not by year end, certainly over a longer period of time, say 2022 plus, there is a room for inflation to pick up. But I think